Manufacturing, another area I'll be watching. It saw a drop in the ADP numbers. 12.9 million, again, was the total level last month, above where it was pre-pandemic, but it's remained much more steady than some of these other areas that have seen big swings. And information is the other area I'll be watching closely. About 3 million jobs total in that industry last month. That compares with just under that in February of 2020 and a low of 2.6 million in May of 2020. But obviously, anecdotally, we've heard about a lot of layoffs in that business.
Yeah, and the larger inclination here is to really read through the figures that come through today and get a sense of where the trend starts to lock in for the Fed and what they're looking for. Of course, the mandate is dual. It is maximum employment, but then it's also in price stability. However, in combating the inflationary pressures that the economy is seeing, they're more willing to let that unemployment rate slip up a little bit in order for them to reach price stability and then for jobs to be able to be reassumed later on down the line.
Joe, real quick, any under the headline numbers that you're going to be paying a lot of attention to?
Well, I tend to look just at the rate-sensitive sectors first, so I really want to see what's going on in residential construction and, of course, manufacturing. We see some of the layoffs in tech, so we'll be looking close at that this weekend.
Yeah, definitely. How about you, Greg?
I'll be looking at what's happening in the retail sector and also in the professional and business services sector, because those will be key gauges as to how strong the labor market is going into next year.
Right. It's an important point, too, that when you look about between information and professional and business services, something else that has characterized the layoffs is it's not necessarily the day-to-day coders, although we've definitely seen some layoffs at places like Twitter with that, but it's executives. A lot of the folks in the sort of C-suites or at least mid-level managers are getting affected by some of the layoffs as well. So that's something to keep an eye on. And just to reiterate the numbers that we're looking for, once again, 200,000 is the headline number that we're looking at. We did get a weaker than estimated ADP number earlier in the week. There's not always, directionally, we tend to see some matching up between these, but they don't match up exactly. But just for what it's worth, that was something we saw. Again, 3.7% unemployment is what we're looking for, and that year-over-year wage gain of 4.6%, 0.3%, by the way, on a month-over-month basis. So those are the numbers as we are looking for them, and we are just seconds away now from those numbers, which obviously have big implications for the U.S. economy and for the Federal Reserve. As the clock strikes 8:30, 263,000. So big beat here on that front. Not seeing the unemployment rate just yet. Here it is, 3.7%. So that number is bang in line with estimates. Average hourly earnings rising more than estimated on a month-over-month basis by 0.6%. So that's a pretty big gain there that we are seeing here. The participation rate ticking down to 62.1%. That's an interesting part of this as well. That's ticking down 0.1 of a percentage point from the prior month. We also have some net revisions over the prior 2 months. Net revisions taking down the numbers by 23,000 collectively for the prior 2 months. But again, to reiterate the overall number, 263,000 jobs added to the U.S. economy last month. That is well ahead of estimates. We are also seeing the unemployment rate match up, but wage growth is still pretty hot. Not as high as inflation overall, but you know, getting there. 5.1% was that year-over-year gain in wages.
Yeah, that a pass-through, or at least a common denominator that we've seen within both of the private payrolls report and now the BLS report that's come through. Those notable job gains that we're talking about here too, occurring in leisure and hospitality, healthcare, and in the government sectors as well. Employment, and Greg, I know you were keeping a close eye on this, it actually declined in retail trade and then in transportation and warehousing. So those two are the key sectors that did see some declines. Just because you were keeping a close eye on retail as well, Greg, just want to get your reaction here on the outset to this report too.
I think in general, this is a pretty good report. It shows that the labor market remains relatively robust, more robust than I would have thought. But this is a payroll survey that takes place in the first part of the month. So I think we have to be careful that this may not necessarily be a signal for what's happening at the end of the month and going into December in 2023. We're expecting some weakness in the retail segment because there was weaker hiring for holiday spending. But overall, this is still a report that shows that we're still seeing a steady number of jobs being created. I think that if we look at anecdotal evidence in terms of hiring and in terms of strategic developments on the labor market front, we are going to see a more significant slowdown as we go into December and next year.
Joe, going to get your thoughts in a second here. Wanted to get on over to Yahoo Finance's Jared Blickery, who's standing by. We've got a big move that's taking place in reaction in the futures here. Jared, what are you seeing?
That's right. The Dow futures now off about 400 points, more than that right now. You can see on the intraday or intranight price action, this is since midnight, really taking a dive here on that report. Let's check out the Nasdaq, which is now down more than that, basically double the Dow, down 2.25%. Very similar chart right there. And let's just check in on what some of the other markets in the futures are doing. Gold took a little bit of a dive here. You can see now it had been in the green, now in the red for about 1%. Interestingly, it had perked up over the last few days. So gold, a lot of people pointing to the fact that it could be on the verge of a breakout. Well, it's breaking out here. That has been on a decline in real rates, but that may be reversing right now. So let's take a look at some of the currency action as well. And in particular, I want to check out the euro because that has been fluctuating around some key levels here. And let me put this on an intraday basis. And you would expect, we see the euro weakening and the dollar strengthening on the move. That's as people believe the Fed's longer or higher for longer, or at least staying the course for a little bit longer. I think that hot wage growth number really putting a damper on equities here. And a little bit tongue-in-cheek, we got to check out Bitcoin because Bitcoin has been highly levered to a lot of these economic reports and what the central banks may be doing. Not a lot of action right there. So I'm going to round this out with a look at copper futures. And then finally, we can see copper heading down as well. And just want to get a check on the interest rate situation. 10-year Treasury note futures really selling off right now, which means interest rates are rising. So a little bit of a hot report there, especially in terms of that wage number, guys.
Yeah, definitely a little bit of a hot report. And as we know, good news for the economy has been greeted as bad news by the markets as of late, right? Because of what the implications for the Fed. Thank you, Jared. Let's turn back to our panel here. RSM Chief Economist Joe Bruce Willis is still with us, and EY Parthenon Chief Economist Greg Dacko. Joe, your initial thoughts in seeing this number that was quite a bit higher than estimated.
So the 3-month average annualized pace of wage growth is now 5.1%. This is a policy important report. What this means is Jay Powell the other day gave us all a big hint at what we ought to be looking at, services ex housing. Wages feed into that. I think everybody on the street's now going to be focused on that next week in the CPI because the Fed is now going to be moving the policy rate above 5% at this point. I just don't see how they can't get around that.
So meaning that will be the terminal rate, but let's bring it back to this month.
Yeah.
Does that bring 75 basis points back? Or is
I don't think that's going to bring 75 basis points back. But what that means is they're going to hike in January, and then they're going to hike again at a slower pace in March, and we're going to be above 5%. Then we're going to have to think about where we're at. I think the policy framework, as I'm looking at this data, as we had 30 seconds to look at it, it does support the Fed's lift and hold framework for next year. And I think that's the real main takeaway here. On another very strong report, the internals were really good on this.
Yeah, there's a ton to continue to break down on about this, and particularly how monetary policy going forward from here. And the futures are clearly reacting to that this morning as well.
Yeah, but I think we have to be very careful in interpreting this as a very strong report. It is only 260,000 jobs, and I wouldn't be surprised looking at the details here in terms of professional business services. I think they were up only 6,000. We have weakness in retail. We are starting to see some weakness in terms of employment. The hiring flows are slowing. We're starting to see more layoffs. Wage growth, as Joe said, is very concerning because the month-over-month momentum at 0.6 is something that the Fed does not want to see, ongoing wage pressures.
And one thing I think it's really important to state here is that at the end of business cycles, the first estimate by the BLS always generously overestimates the true number. We'll get a benchmark revision early next year, and I wouldn't be surprised if really the last several months see some significant downward revisions. And I also think it's important to state that we only need to add 65,000 or so about a month to meet labor demand. The structure of the U.S. labor market's changed. So we're going to see the layoffs appear in the data at one point. It's just not there yet.
Right. And something else I want to point out, and this is something that Chair Powell got asked about in his commentary this week is, gosh, it would be nice if you could let wages still go up and bring all the other prices down, right? Yeah. Right? Because because it is such a blunt instrument, monetary policy, you end up slowing wage growth at a time when prices are still rising. I mean, real wages are still falling if you look at these numbers, right? So But there's no getting around that.
I mean, you can't.
Just to sort of acknowledge it,
with,
right?
With just the interest rate and policy and quantitative tightening, you're not going to be able to fine-tune the Fed's response to the current conditions. So if you continue to tighten monetary policy aggressively, that will have an effect on interest rate sensitive sectors, but on the broader economy over time as well. We've seen financial conditions actually loosen in the last couple of weeks, but the Fed is likely to intend to maintain those tight conditions. One thing I would bring to the front here in terms of the discussion is that the household survey showed actually a significant weakening in labor force participation. So the supply side is also weakening at this stage, which is not what you want to see.
What are people doing at this point?
Yeah.
Right?
All right.
They don't have the savings anymore, do they?
Well, the lower two quintiles do not. They've blown through that. But up at the top, they're just under $1 trillion in savings. So it's two economies on two different tracks. Greg made a really good point on the household survey, which actually declined by 138,000. Now, that's not statistically significant from a certain point of view, right? But the point is the household survey captures a lot of men, say 25 to 54, who work as subcontractors and contractors. And I think that's where a lot of the residual slowing's happening right now. Demand is just not occurring in that sector because those projects are being pushed back to next year.
Yeah. I want to put some numbers on the data that we've been talking about, or at least the broader themes that we've been talking about, because you brought up labor force participation rate. We see that at 62.1%. And then additionally here, as we've been talking about wage growth, as we were pointing out just a moment ago, that sitting at 5.1%. And Fed Chair Jay Powell had said this week, to be clear, strong wage growth is a good thing, but for wage growth to be sustainable, it needs to be consistent with that 2% inflation, to your point, Julie. And then just lastly here, on the sector front, as we were breaking that down a moment ago, because looking through where we saw the biggest gains, and this is a larger question of where we can consider to or continue to see some of that return to work, especially in the leisure and hospitality sector that saw the largest decline earlier on in the pandemic. You saw that move higher, continue to move higher by about 88,000 jobs. Retail moved lower by 30,000 jobs. And then also you saw in healthcare gains of about 45,000, kind of the next big additive sector there. But again, in a report that came in better than expected here, now the question is where some of the consistencies between the manufacturing space, where we have seen some significant declines, private payrolls, we saw that move down by 100,000. Where does that also start to show up even more so in the BLS data as well here?
I think, just to look back at one of the reports that we had earlier this week, the ADP private sector report that we had, I think that's likely to be the template going forward in terms of where we're going to see the job losses. We're going to see some weakness in manufacturing. We had the ISM manufacturing survey earlier this week that showed a contraction in manufacturing activity. So we're going to see some weakness in manufacturing. As Joe mentioned, construction is, of course, going to be under pressure. The tech sector, information sector, also are likely to be under pressure. And then retail, transportation, warehousing, those were sectors that were doing relatively well, likely to see a pullback. And I wouldn't be surprised to start seeing, even in the finance and professional business services, more weakness as we move into next year. That makes the picture very difficult for Fed Chair Powell to navigate, because high wage growth pressures along with a softening labor market is the ideal opposite of what the Fed would like to.
And by the way, transportation and warehousing was down by 15,000 in November.
So as I look into this, right, private service providers added only 184,000. You got a 42,000 person increase in government, and it was all state and local governments. Okay, guys, with the stock market selling off, tax revenues, capital gains tax is not going to be showing up. That's clearly not sustainable. So as we approach the end of this year, this is one of these jobs reports where we should all shake hands, have a good weekend, good top line. This isn't sustainable.
Maybe don't go crazy with the holiday spending. I don't know. But on the other, one of the things that we were hearing about is that going into what many think is going to be a recession, that it would be a relatively minor one. And for that reason, the thinking was maybe layoffs would not be as high as they were in other recessions because, given the difficulty finding workers over the past 2 years, maybe employers would be reluctant to lay off people because of fear of trying to get them back when things rebound, if they expect that to do quickly. Is that thinking still in place?
That's still in place, but that's shifting. A lot of the clients we speak to are talking about this idea of the value of talent being much higher than pre-pandemic, which means you want to hold a key share of your labor pool. It does not mean you're not going to proceed with any layoffs or any strategic hiring freezes in terms of your talent pool. So we are hearing more and more businesses are resorting to attrition as a mean to allow to right-size their labor talent pool. We're also hearing of layoffs being strategic, and we're also hearing of hiring plans being revised. I think to go back to Joe's point, which I think is very important, we're likely headed in this first part into a K-shaped recession. The well-off are likely to be well-off for the foreseeable future. The lower income tranches of the population are the ones that have to bear the brunt of this high inflation, high interest rate environment. And it's no surprise that we saw yesterday a near all-time low in the savings rate because people are dipping into their savings and using credit to offset the burden of inflation.
Labor hoarding is an actual phenomenon
Right, I
that we
couldn't remember the name
need
of it.
to
Labor
really
hoarding.
talk about.
Yeah.
And then look, we're proceeding through a really big structural change in the labor force. You know, for my entire life, we added 1% per annum to the labor supply every single year. It was like death taxes and the sun coming up. We're slowed to a crawl now. We simply just don't have enough people out there. We're going to have a recession, but I don't think the unemployment rate's going to climb much higher than 4.7 to 5% at worst. That's not going to look like all the recessions that Greg and I have studied and lived through, right?
It's like Elon Musk says, we need to start having more kids.
We need to, well, that's a different discussion for a different show. We might, I was just in Washington this week, we might want to have a rational conversation around immigration.
Yes.
Around green cards for anybody who comes here and gets more than a master's degree, they get to stay and they get to increase our productivity. There are very direct things that we could do to ameliorate some of this in the near term. But we have to be able to talk to one another, and that's the real problem, is we can't talk to one another about this yet.
Yeah, that's something very similar we heard from former Cisco CEO John Chambers actually earlier this week as well, with regard to talent and making sure that talent is able to have the opportunity to come into the U.S.
The last thing is I'm talking to our clients. A lot of them are just substituting labor for or technology for labor right now because they just can't find the labor. And that's another question about automation. I think that's a more of a medium to long-term phenomenon.
Yeah, absolutely. Much more to be discussed here on the desk for sure today. Thank you both so much for joining us. RSM Chief Economist Joe Brasuelas and EY Parthenon Chief Economist Greg Dacko. Thanks. And everyone, just to recap some of the numbers very quickly here, the total jobs added during the month of November here in the U.S., that was 263,000. And then the unemployment rate, that was unchanged at 3.7%. But you're taking a look at some of the numbers. We're going to continue to do a deeper dive on the other side of this short break into how the jobs report is impacting the markets. That's next.
Recapping the jobs numbers that we got just a little while ago, 263,000 jobs added to the U.S. economy last month. That is much stronger than the 200,000 that was estimated. The unemployment rate bang in line with estimates at 3.7%, and hot wage growth, 5.1% year over year. Let's dig into this a little bit more. Also talk about the implications for the Federal Reserve. Yahoo Finance's Jennifer Schonberger is joining us now with that. Good morning, Jen.
Good morning, Julie. Yeah, with a stronger, hotter than expected jobs report of roughly 263,000 on the top line, that's roughly in line with where the job market stood in October, when we knew that the Fed thought that the job market was strong at that point. So this jobs report likely to keep them on track, viewed as strong from the vantage point of the Federal Reserve. Fed Chair Powell saying in his speech Wednesday that the job market is still strong and probably too tight yet to bring down inflation. He suggested the economy only needs to add about 100,000 new jobs a month to keep pace with population growth. He's also looking for wage growth to slow down and be consistent with 2% inflation. Of course, the Fed sees the job market as vital in the fight against inflation and wants to see the labor market come into better balance to cool inflation. So if we look at those numbers, kind of taking a deeper dive, 263,000 on the top number versus 200,000 expected, that's in line with the average growth over the past 3 months of 282,000. So we're not really seeing any cooling here. The unemployment rate unchanged at 3.7%. Wage growth very hot at 5.1% versus 4.6% expected. And remember, on Wednesday, Powell said, to be clear, strong wage growth is a good thing, but for wage growth to be sustainable, it needs to be consistent with 2% inflation. So he really wants to see wage growth around 2 to 3%. Now, we also saw notable gains in the sectors of leisure, hospitality, and healthcare, all services. And so the job market, which is especially important for inflation in core services ex housing, still remaining hot right here. So all of these measures indicating across the board that the job market's still out of balance for the Fed. All this said, Julie, the Fed's still likely on track for a 50 basis point rate hike in less than 2 weeks. The Fed chair says that the time to begin slowing down the pace of rate hikes could come as soon as December. And the reason for that is really risk management. The Fed has been going at a 75 basis point pace for the past 4 meetings. And they don't want to crash the economy. They don't want to be overly aggressive, but they still want to bring inflation down, which is why 50 basis points probably still on the table, despite this hotter than expected jobs report. Back to you.
All right, Yahoo Finance's Jen Schonberg, a really solid dive on some of those numbers here. And for more on the November jobs report, we're joined by New York Life Investments economist and portfolio strategist, Lauren Goodwin. Lauren, great to have you here on set with us. A lot that we've been continuing to break down in terms of some of the data that's come out this morning from the BLS on the monthly jobs report side. But if you are looking at the market reaction this morning and trying to position your trade going into the start of today's activity, I mean, what do you have to think? What do you have to position yourself and position your portfolio best to do in this environment?
You know, I have to say, looking at Wednesday's reaction to Powell's speech at the Brookings Institution, I understood why the market was excited to see a slowdown in the pace of rate hikes, but I think today's reaction is more likely to be appropriate to where we are in the economy, which is a still super hot labor market, inflation that's going to move lower, but probably at a very slow pace, and one in which the Fed has been actually pretty consistent in telling us that the hotter this labor market is, the hotter inflation is, the more challenging it is for the economy actually in the medium and the long term. And so in terms of the market reaction, I think this is appropriate. Now, when we think about how we can consider that over the next couple of weeks, maybe next few months, this is a market that has been driven consistently by what the Fed's messaging is, or its interpretation of the Fed's messaging. I think the Fed has actually been pretty consistently hawkish, and we should take that to heart with today's strong jobs report.
So we earlier heard Joe Brusuela saying that this report, especially the wages part, makes it more likely the terminal rate's closer to 5. If that is the case, what does that mean for stocks? Are stocks appropriately priced right now if the terminal rate is 5%?
It's probably going to be negative for stocks. It's one of the reasons why we're very cautious in equity moving into the first half of next year. The equity market, although the bond market has at times priced a pretty appropriate Fed hiking cycle with fewer rate cuts over the course of next year, the equity market again has moved very much in line with the day-to-day data. The path ahead, I completely agree with Joe that the path ahead is likely to be 5, maybe even higher in the terminal rate, and the Fed has said that. And so in equity, we have to be really cautious. Now, not equities are all created equal. There are some opportunities we see. We're looking specifically at the equities that bring quality, defensiveness, and income in a portfolio to help bring some resiliency. But it is likely to be a challenging market ahead. I'll give one caveat, which is that in this market, because it is so Fed narrative driven, you have 5% up days. And so we believe we need to be fully invested, but again, it's how to be invested that's important.
Some people look at that volatility and they say, you know what, I'm just going to look towards the end of the year. I'm going to set the cookies out for Santa. I'm just going to call it a day, and then we'll reapproach this sometime when I feel more comfortable and things have settled a little bit. And you can point to this week as still one of those volatile moments here where you've got commentary from Fed Chair Jay Powell, but also you've got, of course, the economic data that's continued to come out on the employment situation front. So for those who are saying, you know what, I'm just going to kind of hit the pause button for right now, even if the Fed hasn't hit pause yet, what do you tell them to keep them engaged within the markets right now?
You know, if someone said, I'm going to hit pause as in I'm going to set it and forget it, I'm okay with that.
Okay.
For someone who's saying, I'm going to go all cash, that's where, from an investment behavior perspective, I think it's troublesome, because the hardest thing is always getting back in. Right? And so we're looking at all-weather strategies for the period of volatility, let's call it the next 3 or 6 months that we expect is ahead as economic growth starts to slow. I mentioned a few of the factors that we like in equity: quality, income, defensiveness. That's a pretty compelling story for actively managed value equities. So if you're going to set it and forget it, maybe there's an opportunity to set it and forget it in strategies like that. Infrastructure is another one where you can have reliable income built in a portfolio, maybe cash flows linked to inflation, a way to essentially build resilience, not just against the volatility we see in the market, but inflation. You know, at this point, with inflation running 6.5%, 7%, that's taking a bite out of total return if you move out of the market. And so we have to balance those risks as investors.
What does defensive mean to you right now? Like, has the definition of defensive changed over time? Like, we tend to think of it as classic, certain sectors are defensive. Is that still how you think about it?
It's part of it. I think there are sectors that provide some more consistent resilience to the market, but it's not just resilience to the economic cycle. Again, it's resilience to inflation. And so that's maybe a way in which we can think of defensiveness having changed. And so that's why while I gave the example of value equities, that's maybe more traditional, your utilities, your staples, your healthcare, your financial services. There are compelling stories in each of those. They're expensive. Sometimes things are expensive for a reason. But then there's also, but there are additional strategies. So I gave infrastructure equity as another potential interesting example. That's not just bridges and tunnels, but also communications infrastructure, digital infrastructure, green energy infrastructure, where we do see not only spending, but contracted cash flows. And so again, those are some ways that you can build resiliency against not just the cycle, but the inflation side of the equation.
Earlier this week, we were in the frame of mind that, hey, maybe the Fed's just cleared the way for a Santa Claus rally at the end of the year. And now you get the economic data today, and perhaps that's not the case. But from your perspective, should we still be looking out for any type of near-term Santa Claus rally, as cyclical or as expected as it may have come to be?
I don't expect that we'll see a consistent rally, but I do think that we could see some good days. We have a couple of big data days, as well as Fed and other central bank meeting days. There's lots of messaging that we're going to get. I expect some will be taken as hawkish, some will be taken as dovish. And so again, being invested in that environment makes sense to me. If I were thinking about, what are the types of things that I'm going to start to be either dollar cost averaging into or adding as we move closer to the end of the year, I'm actually really interested in taking a look at credit. Because while the volatility that we're seeing in the market and the uncertainty around Fed messaging has been really challenging for equities these past few weeks, as we get a line of sight on the terminal rate where the Fed may pause, it's actually really constructive for credit.
Sure.
Yields are higher. Pricing has adjusted. And so even if you do still see some volatility as economic growth slows, you're clipping that coupon, right? And so as rates move higher, that's potentially interesting. Again, assuming that we are getting closer to that 5.25% where the Fed will stick around for a while.
Yeah, I like your comment. And some things will be read as dovish, some will be read as hawkish. Sometimes it's the exactly same thing said.
Yeah, exactly.
Lauren, great to see you. Thanks so much for helping us make sense of how to think about investing based on this jobs report. New York Life Investments economist and portfolio strategist Lauren Goodwin. Appreciate it. Coming up, a redirection for the much-feared rail strike. We'll break down the Senate's new bill and, of course, continue to discuss jobs next. Welcome back to Yahoo Finance Live on this Jobs Day, Friday, December 2nd. I'm Julie Hyman. That's Brad Smith. Brian Sazzi's on assignment. It is indeed Jobs Day, and the jobs report came in hot. The U.S. economy added 263,000 jobs in November, higher than the expectation for 200,000. Unemployment at 3.7%, although, as Greg Dacco pointed out to us a little while ago, it's not fantastic. I mean, it's slowing job growth. It's just better job growth than was estimated. And we are seeing a negative reaction in markets, particularly to the wage number, 5.1%. So that caused, of course, Brad, a drop-off in the futures.
Yeah, we're looking at a drop-off here about 30 minutes. We're 29 minutes outside of the start of trading. For the S&P 500, it's down by about 1.5%. And all of the major averages moved in stark reaction to this, or immediate reaction to this jobs report. Take a look at the Nasdaq futures, down by about 2% right now, as the Fed had already kind of initiated the not all clear earlier this week,
right,
but did couch some of their statements with saying we're not going to finish, or we're not going to stop until the work is finished, essentially.
Yeah, and speaking of the Federal Reserve, of course, we have to keep an eye on treasuries. This is treasury prices, so when the price goes down, yield goes up. The yield is going up today. We had seen a big pullback in yields earlier in the week after we heard from Jay Powell, and now we are seeing a reversal of that.
That's right. Well, let's get into more of the market action off of this November jobs data with Yahoo Finance's own Inez Ferre. Inez, you've been pouring into some of these numbers here. Let's recap and see what's actually taking place here within this November's jobs report as well.
Yeah, hotter than expected, to say the least, when it comes to this jobs report. 263,000 jobs that were added in November, and the expectation was to add 200,000 jobs. You see there the unemployment rate at 3.7%, coming in line with what was expected. But average hourly wages rising by 5.1%, as Julie had mentioned. That's hotter than expected because the expectation was for 4.6%. Jobs pretty much across the board, except for a couple of sectors. You saw leisure and hospitality adding 88,000 jobs in November. Healthcare jobs rose by 45,000. Government added 42,000 jobs. The services industry added 24,000 jobs. Even construction employment trended upwards. Now, we did see a decline, a contraction in retail trade. Those jobs declined by 30,000 in November. And also transportation and warehousing declined by 15,000 in November. So this kind of jives goes in line with what we've been seeing in the retail space, some contraction there, in consumer discretionary, also in volumes for shipments that we have seen some of the big shipping companies talking about a decrease in volume. Now, keep in mind, as one of your guests was talking about earlier, that this is really measuring the first half of the month, the first couple of weeks of the month. So we're not really seeing the tail end of it. Wages growing, that is a problem, of course, for the Fed, because that means that the Fed will have to continue to tighten. Labor force participation coming in at 62.1%. That's another problem. And Jay Powell this week had talked about the participation gap in the labor force, talking about also early retirements, and talking about how the stock market increasing and rising house prices gave way to more early retirements. So how do you fix this? Well, by making the unemployment rate go up and by bringing wages down. So this is really a tale of two jobs, so to speak, when we look at this, because we are seeing these headlines of job losses, hiring freezes, but at the same time, we are seeing some hotter than expected report, but it just may not be showing up yet in the numbers.
Yeah, and there was a tweet from Lizanne Saunders that I like, where she said, "Take that, pivot pushers." In other words, the people have been betting on the Fed to turn, to pivot. I mean, I think that narrative is pretty much gone now. The Fed has killed the pivot narrative, right? But this jobs report just goes, again, further towards making sure that narrative is good and dead.
Yeah, it's a lagging indicator, and we have to keep in mind that it is a lagging indicator. And what you're seeing also in the headlines are sort of the big companies, the big headlines about these layoffs. But nevertheless, in real life, I mean, you must be seeing it as well. We see this, the sort of the contraction and the consumer that is also pulling back as well. So it's coming. It just takes time.
Yeah. All right. Thanks so much, Inez. Appreciate it. The U.S. Senate has passed legislation to prevent a rail strike in a series of hurried negotiations just days before crucial shipments were set to be sidelined. Yahoo Finance's Rick Newman has been tracking all of this action. Good morning, Rick. How you doing? So it seems like that they have averted this. It seems like the president is set to sign it here. And I believe the sick leave provisions were kept out of this final agreement, correct?
Right. So basically what both houses of Congress have now done is basically ratified the deal, ordered both sides to accept the deal that was negotiated a couple of months ago at this point. There was a small chance, and Congress could have done this. They could have actually changed the deal and said, given the railway unions what they were asking for, which is instead of 1 sick day per year, raise that to 7 sick days per year. But it looks as if there were not the votes in the Senate to do that. The House actually did pass that, but it looked like the Senate just didn't have the votes. And let's keep in mind, it would have required 60 to overcome the filibuster in the Senate. But there were large numbers that voted in favor of just ratifying the deal that was there. And President Biden's going to sign this, and that's the end of the story. We're just not going to have to deal with a rail strike. And I think everybody's pretty relieved about that.
All right, well, since it's the end of the story there, what about for the Supreme Court? They've agreed to hear President Biden's case on student loan debt forgiveness. Rick, what can we expect?
Well, the plot thickens there. Totally different story. So the courts have stopped in place Biden's debt forgiveness plan for up to $20,000 in student debt forgiveness. I think everybody following this knew there were going to be court challenges because Congress did not do this by passing a law. Biden did it by executive order, and there are real questions about whether he has the authority to do that. So legal action against it was inevitable. That happened. There were some appeals courts, at least 2 of them said, okay, we're putting the whole thing on hold while it goes through the legal process. The Biden administration went straight to the Supreme Court and said, instead of making this go through the courts for years, can the Supreme Court just take this case? And yesterday, the Supreme Court said, yes, they are going to take the case. They will hear it in February with a decision likely by the end of June, which is when the court's term ends. And I think there is considerable likelihood that the Supreme Court is going to say, no, the president does not have the authority to do this and strike the whole thing down. This Supreme Court does not worry about upsetting anybody with unpopular opinions, as we know from the overturn of Roe v. Wade last summer. So it is very possible the Supreme Court could say, no, the president can't do this, and it would not happen at that point.
Yahoo Finance's Rick Newman. Thanks for breaking this down and, of course, tracking all the moving parts. Appreciate it, Rick. And switching gears, everyone, Ye, formerly known as Kanye West, has been suspended on Twitter by Elon Musk after posting anti-Semitic images that Musk says violates the platform's policy against inciting violence. Yahoo Finance's Dan Halley is here with more. Dan, what do we know about the extent of the suspension and ultimately what this signals for Twitter in their own policies going forward, too?
Yeah, I mean, this really is kind of an unprecedented time. This guy has the ear, or I guess had the ear, of Elon Musk. Kanye West posted a text message between him and Musk where Musk basically, criticizes him for this post that he put up, which was a swastika inside of a Star of David. This followed Kanye West's wild tirade about Hitler on Alex Jones, a conspiracy theorist show, basically praising him. And so now he's just fully suspended. We don't know how long the suspension is going to last. There's no bans. He's suspended, just like we had seen other accounts suspended on Twitter before. No one's ever been fully banned forever. But, this just kind of comes at a time where, Musk has that blanket amnesty issue going on where anybody that didn't say anything illegal or wasn't exceptionally spammy is allowed to come back on. Those thousands of accounts will be able to come back. And at a time where, you're talking about Twitter and Elon Musk and how he wants to be saying he wants to be a free speech absolutionist, but then having this kind of come out, someone that he's been in contact with, it really does kind of slap him in the face. And as I said, there was that text message exchange between the two. So this was someone that he clearly had spoken to and he welcomed back onto the platform not more than a few weeks ago.
Yeah, not more than a few weeks ago, and said they had spoken, he was assured that, or reassured perhaps, that Ye would not make these kind of comments. Thanks so much, Dan Halley. Appreciate it. Obviously this whole business is a risky one, both from a curation and moderation perspective and balancing that between that experience for most of the people on the platform and having the attention that someone like Ye has with his 32 million followers that he had before this suspension. But we have gotten a little bit more information now about where the line is for a Twitter under Musk. Mm-hmm. One, he doesn't like Alex Jones. He said that in a tweet recently. He's made that clear. And two, incitement to violence seems to be this line. Yeah. But that's a fuzzy, it's a difficult line to draw perhaps at times.
He tweeted that out saying, despite that and that being him reaching out to Kanye West or Ye and saying that what he was doing was going against their policies, he again violated our rule against incitement to violence. Account will be suspended here. Now, when you think about what Elon Musk has undertaken in needing to moderate, or to the extent that you're keeping Twitter safe, even if you are trying to champion free speech, there is a far difference, or at least we're trying to understand now under Elon Musk what that line is between what he sees as free speech versus what he sees as hate speech. And because there has been so much hate speech that has now become even more prolific as a result of him taking over the platform, where will the platform itself need to make sure that the algorithms that Elon Musk touted he was going to bring into the equation when he took over the company, where will that be able to flag some of these instances and ultimately result in some type of account suspension or other activities similar to this case as with Ye. And for Elon Musk, it also comes at a time where you're trying to just keep advertisers on the platform too.
Right.
And advertisers seem to be pausing their campaigns en masse right now.
Although Twitter is now reportedly offering incentives to some of those big advertisers to stay on the platform. One small note as well as the difference between pre-Musk Twitter and post-Musk Twitter when there are suspensions. Before, all of the past tweets were taken off the platform for the time being. Now the past tweets, aside from the one that was flagged, can remain in place. So that's just something to mention. Something else to mention, by the way, is that Ye's agreement to buy Parler, the right-wing alternative social media site, has now been dissolved. It's been agreed upon with both parties, but Parliament, which is the owner of Parler, said the deal was made in the interest mainly due to his recent and well-publicized business difficulties. When you lose Parler, right, you know, in other words, this is a right-wing social media site. When they won't deal with Kanye, now whether that's because of his commentary or because of his very public erraticism, maybe the latter, maybe that's more the issue.
Yeah, when you lose Parler and then your last resort for posting becomes Truth Social, which we've seen some screenshots about Ye then needing to default after to try and still have some type of microphone on Truth Social, that's even more telling as well here.
Right, if you put out hate speech and you don't have a platform at all, maybe that ideally is where we get to.
There you go.
Coming up, why our next guest says recession is almost a certainty. What do you do as an investor in that environment? We'll talk to Gargi Chaudhry from BlackRock next. Stock futures continue to trend lower after the latest jobs data showed stronger than expected hiring momentum and wage momentum. Unemployment held steady at 3.7%. Wage growth picked up to 5.1% on a year-over-year basis. Joining us now for more on the market action is Gargi Chaudhry, who is BlackRock America's iShares investment strategy head. Gargi, as always, it's good to get some time with you. I know you just came out with your 2023 investor guide. Given the jobs numbers that we just got this morning, how does that feed into your economic projections and what investors really need to be zeroed in on going into next year?
Sure thing. Good morning, Julie. It's great to be here. So obviously we got a interesting, jobs number, and I don't think that changes how we're thinking about how investors should be positioned for the next 3 to 6 months at all. You know, what we lay out in our investor survey is that there is a huge amount of opportunity in the fixed income markets, one that we haven't seen in about a decade and a half, and investors should be gravitating towards the income produced in the higher quality sections of the fixed income market. And honestly, a day like today with yields backing up, getting back to levels that we had seen prior to Chair Powell's speech at the Brookings, I think provides a better opportunity to enter some of those trades. So while the data today was certainly stronger than many had expected, I don't think that changes the dynamics, especially going into the December Fed meeting.
Gargi, you also discussed value-style equities within some of those 2023 investor guide ideas. And so break that down for us and where potentially for people positioning their portfolios, even going into 2023, where they can still maximize returns, but also be in a defensive environment as realistic as necessary.
Absolutely. So as you'll remember from the last few times I've been on your show, we've had a very cautious approach to equities. We've been talking about owning healthcare providers. We've been talking about minimum volatility strategies. And there's still more downside to be seen in the equity markets, to be honest. I mean, we are probably going into January earnings season. It's going to get some revisions lower to earnings forecasts. But having said all that, I think we need to readjust what we think we should invest in when the market rebounds. So when you buy the dip, which everyone wants to do, what should you be buying in a higher rate environment? Now, remember, the last 10 years or so, we got used to a negative real rate environment. And now we know that we're going to stay in a regime of higher for longer, not lower for longer. And that actually bodes very well for allocations to the value style factor, to things like IWD, which is an iShares ticker that we are recommending to our investors, or an IVE, or even a VLUE, which are great ways to get access to that value component. So again, thinking back to what interest rates should do for the next 3 to 6 months, we think they're going to stay high like they are today. And again, that means value should outperform much like it has done this year.
And now, given all of that, Gargi, and given that you and many are forecasting a recession, given that a lot of strategists are not looking for many gains in the overall stock market next year, should people be thinking about 2023 through a capital preservation lens or through a wealth building lens or some other lens?
Yeah, I think that as we think about 2023, I do think it's going to be a year of two halves, or at least based on what we've seen from the Fed and seen in the data so far. I think there's going to be the first couple of quarters that you're probably supposed to, again, allocate to fixed income, allocate to value parts of the equity market, which will fare better. And then as we get to the recession, look, it's not going to come upon us immediately. We do think it'll arrive at some point in 2023. And as we realize we're falling into a recession, the Fed most likely will change their language. Again, not pivot, but they'll certainly make sure that we understand that they're not over tightening policy. And I think they told us that earlier this week at the Brookings as well. And I think at that point, you're supposed to allocate to, more riskier parts of the market because the Fed is giving you that green light. However, for the first quarter, at least, looking from here to March, bonds should play a very big role in your portfolio. And especially on days like today, when yields back up a little bit, I'm actually very excited about that because it gives investors an opportunity to re-enter sectors of the market, such as front-end credit, such as mortgages, such as TIPS, and even front-end treasuries.
We were discussing earlier here in the show that we may not get, just a straight up type of rally, basically, or just some strong rally, but there could be some good days and there could be some volatile bad days. What would you say to anybody that is just saying, you know what, I just want to sit on the sidelines for a little bit right now?
I would say that it's all about how much time you spend in the markets. We've done so much work around, looking at previous cycles, where if you've just missed 5 or the 10 top performing days in the market versus being invested for the entire period of time, your returns over the next 5 or 10 years have been significantly more superior. So if you're staying in the sidelines, look, I get why you're doing that. The 2022 has been a really difficult year for investors. I get it. But I would say play the long game here. I think, over the next 12, 24 months, are we going to look back at these levels especially the bond markets, especially in some pockets of value equities, even perhaps at some point, if we're looking out for 5 years, are we going to look at sectors like semiconductors and stocks and wish that we had bought them? Sure. So play the long game. I know that it's hard with years like this, but I think it starts building up really good opportunities in the market and, make the long-term investing your North Star.
It's an even harder year, Gargi, when your hometown Phillies lose the World Series. Gargi Chowdhury, BlackRock America's iShare investment strategy head. Thanks so much for joining us and giving some of the key themes to watch for and perhaps put into motion in 2023. Appreciate it.
Thank you.
Great to see you. Guys, coming up, Zscaler. It's taken a hit from its guidance despite reporting an earnings beat. We've got that, plus the opening bell on Wall Street. Up next. Still a few minutes until the final opening bell of the week, and before that, we want to take a look at few of our trending tickers. One of our trending tickers right now, Zscaler on the day or pre-market, you're seeing that down by nearly 12%. Ticker symbol ZS, that's in focus this morning following an earnings report that saw the cybersecurity company beat estimates on the top and bottom line as revenue for the first quarter grew 54% year over year. Yeah, actual versus the estimates up on screen for you there. It was a beat on both the top and bottom, as we mentioned. And then additionally here, the revenue growth, as I mentioned, 54%. Calculated billings, that grew 37% year over year as well. And then also one of the other major things that the company had noted was the customer engagement. Customers engaging with them to embrace zero trust architecture, eliminate point products, and then simplify IT and standardize. What that all means is that perhaps there are people who are leaning more into some of their services, knowing that you need a holistic, and we were talking about this yesterday, a holistic cybersecurity kind of privacy approach, as there are so many looming threats that just continue to multiply seemingly in this environment too.
Yes, and yet the stock is down 11%. So what's going on there? So what seems to be going on here is you just saw the guidance up on the screen for the calculated billings. $1.94 billion is what analysts were looking for. So there seems to be some disappointment that while Zscaler raised the lower end of the forecast, it didn't raise the upper end of the forecast. Perhaps that's what's going on. Just looking at some of the analyst commentary that we got out here, that seemed to be the report is being seen as negative and that the upside wasn't enough, according to the folks over at Vital Knowledge. So that seems to be it. The forward PE on this stock is relatively high relative to the rest of the sector. So that seems to be why people are looking at this maybe with a little bit of a skeptical eye. And that's, by the way, even after the stock is down more than 50% on the year. So most of the analyst commentary I saw was still not negative on the company per se, but that is where the disappointment perhaps lies.
Yeah, it's an interesting company too. And I think for a lot of the ERP or even just broader business-to-business based companies that are required to sell into both their portfolio clients as well as try to attract some net new customers, this is going to be a tough period because you've already seen so much of the cost restructuring that's come forward from businesses and entities, and everything from the headcount reduction or headcount hiring freeze side all the way to the applications, internal applications that they are using as well. And so that's where it's going to be one of those periods that could be more challenging for them to sell into that total addressable market. However, this, as they mentioned, this is an elevated threat environment that coming from Jay Chaudhry, who is the chairman and CEO of Zscaler.
Right, friend of the show. And we're looking at a board there of some of the other companies that came out with their numbers. Now, of those, Marvel is a chip maker, but the others are all kind of software companies, cloud adjacent companies. And you can see most of them are down after earnings. All these companies reported earnings. The exception for these is Smartsheet. We're going to delve into the broader software sector and some of these individual names a little bit later on with Rishi Jaluria of RBC Capital Markets, who covers the software space, Salesforce as well, which has been interesting to talk about how these companies are navigating this current period, which, as you were just talking about, is a pretty challenging one. So stay tuned for that conversation in a bit. But we are coming up on the opening bell here on this Jobs Friday. We have been seeing a lot of selling pressure going into the open because of the stronger than expected report, particularly for the wage growth that we saw. And so, and the implications for the Federal Reserve perhaps having a higher terminal rate as a result. So that's why we're seeing the slower open. As we see the opening bell here, CIBC Miracle Day and NBA star Charles Oakley ringing that's the taller fellow than the rest who are ringing the opening bell here on this Friday morning. So as we look at at stocks now as they open up, we are seeing declines across the board for the major averages in the wake of that jobs report. It looks like, is the Nasdaq open there? I'm guessing it hasn't opened quite yet, and that's why we are still seeing green being reflected there, because we're definitely going to see a red open for the Nasdaq.
Indeed, yeah, just calibrating a bit here as we get through that opening cross. And yeah, we saw the Oak Man there up on the podium at the NYSE. I'm sure a lot of the traders down there on the floor of the exchange recognize exactly who he is from his days with the Knicks and, of course, several seasons in the NBA. But taking a look at these declines, they're going to recognize that type of reaction too on the good news is bad news type of environment that we're seeing here. On the economic data front, we saw some of the better jobs reports, or at least that 260,000+ jobs that came out above expectations. That immediately reacted, or saw the major averages react. We're right now down by about 0.9%, 300 points for the Dow Jones Industrial Average. Let's see if the Nasdaq Composite is calibrated here. We're going to continue to keep a close eye on that as well. The S&P 500, you're seeing that down by about 1% here out of the gate, though. But then additionally, let's take a look at some of the sector activity that we're tracking right now this morning. As we're taking a look at the 11 S&P 500 sectors, not one green spot to be found, as we had seen that broader dip really kind of permeate across sectors here. You're seeing the biggest laggard, though, right now, real estate. That's down by about 1.5% out of the gate this morning. Energy, that's even joining the negative gains party here. That's seeing some catch up on its shirt by about 0.3%. And so we'll continue to watch all of this. But again, the S&P 500 more broadly down by a little more than 1% out of the gate. A little catch up.
A little catch up on the shirt. I
Yes,
guess shares of Open Door, that's another mover that we're watching, are down about 5% this morning following a surprise shakeup atop the company. The online real estate platform announced Thursday that Chief Financial Officer Carrie Wheeler has become CEO and a member of the board of directors, effective immediately. Former Chief Executive Officer and co-founder Eric Wu will be transitioning to a new role as president. And again, this was a surprise. It was not something that the company telegraphed, and it's been a tough time for Open Door, right? Open Door is the company that very visibly had done the iBuying, right, where they were also buying real estate and trying to flip it, and then were caught with a lot of inventory that they could not get rid of. And so some of the analysts questioned the timing of this towards the end of the year, that it was a bit unusual and, again, a surprise, but, you know, that's maybe a change that needed to happen. I don't know.
Yeah. I mean, if anything, you would want to bring perhaps, hopefully, I guess, the CFO into this role at a time where the financials are going to be heavily scrutinized among investors, given the history that you mentioned that Open Door has with the inventory that they had taken on and then tried to work through. And in an environment now where you've got rising rates certainly impacting some of the demand within housing, and the number of bids even continuing to decline for some of the existing homes that are out there, and the additional difficulty of even bringing new homes to market right now. And so as we start to churn through some of that inventory for companies like Open Door, or even some of the other banks that had made significant purchases over the course of the pandemic, and then immediately thereafter, when you had a more favorable mortgage rate environment for them to be able to take advantage of, there is still this consideration for how much that would have more of an outsized impact on a company like Open Door. And perhaps this latest executive changeover will give them just some fresh minds at the top, at least those that are still within the company,
right,
and know how it operates. But it seems like there's a little bit more of that clearinghouse, at least, that's going to be taking place. You've got one of the presidents that's resigned from their role. Andrew Lo Aki resigned from his role, is going to be pursuing some other opportunities as well. So we'll see who starts to backfill some of those chief, or at least most executive positions within the company.
Right. One analyst at KeyBank saying maybe now people are better aligned, their skills are better aligned with the roles that they're in.
Absolutely.
So we'll see if it works out that way.
Well, let's talk about shares of Ulta Beauty here as well this morning. Ticker symbol ULTA. You're seeing that down right now by about 1.4% following an earnings beat for the third quarter that saw the cosmetic company beat estimates on the top and bottom lines, as same-store sales grew 14.6% year over year. And there you're taking a look at the actuals versus the estimates there. The revenue, about $2.33 billion. EPS that came in at $5.34 versus that $4.15 that was expected here. But for Ulta Beauty and for the broader beauty landscape, we've continued to really try to get a sense of where this little luxury annexation might continue to be a tailwind for them, at least as consumers are looking across their own spending habits and patterns and trying to just lean into the things that make us feel good. I mean, when I get my makeup for the show, it makes me feel good.
Doesn't make you feel good?
It makes me feel
Yeah,
very
you
good.
feel like you're ready for the day. You're ready to take on anything.
At least for 2 hours.
Yes, at least for 2 hours. And if you look into some of the internals of this and of the forecast from the company, you see there the growth outlook here for the third quarter. Comparable sales of 14.6%, pretty impressive there. And the company's forecast for the full year is for sales to rise by up to $10 billion. So that's an increase of the prior forecast there. Looking at some of the analyst commentary on this one, seeing that the company's loyalty program continues to grow. So that's something that is interesting here. 39 million, according to Piper Sandler, is how many loyalty members this company now has, and that Ulta continues to be a name to own in the beauty space, and that it can drive engagement. One other interesting commentary from Piper Sandler on this is it's not only proven itself to be one of the more resilient names in beauty, but also a name with strong momentum that's likely to persist. So in other words, you have beauty, which to your point is a category that has been resilient here, and then you have this company within beauty that has been resilient, perhaps because it is also not viewed as an expensive, in the range, on the spectrum of beauty names. It's not super expensive.
Gross profit, that also jumped 22% in this quarter too. That's compared to that $789.5 million that they saw in the third quarter of fiscal 2021. This quarter, it was actually $962.8 million. So that really showing some of the strength within the beauty category. And then it's all about how they're operating right now too. Operating income, you saw that increase by about 27.3%. So for the company, just showing to investors that they can continue to lock in margins over an extended period of time, even if consumers at some point do shift their spending or purchasing habits and are buying less or at least replenishing less of their own makeup, then that is something that investors perhaps will favor. But here in a down day, we're seeing shares move lower here right now.
All right, coming up, Yahoo Finance's Jared Blickery is going to break down the latest market action on the back of those November jobs numbers. That's next. Welcome back to Yahoo Finance Live. Let's get to Jared Blickery at the Wi-Fi Interactive to show us the market action on the back of those jobs numbers. What's going on, Jared?
Yes, we got a little bit of a negative price action to conclude the week here. Let's take a look. S&P 500 down 1% at high hourly wage growth, really weighing on price action. Here's a 2-day look, but let's take a look at the 5-day price action. You can still see holding on to gains, just small gains there. Let's take a look at the Russell 2000 as well, still holding on to some of its gains. But I want to take a look inside the bond market. Here's a 5-year T-note yield. I'm going to put some candlesticks on. We are climbing back above. Now, we had broken down yesterday. 10-year looks very similar. And now we are in an engulfing, bullish engulfing candle, So you got to wonder, is this a false breakdown? And that's something I'm also seeing in the potential for the dollar. Here we did have this resistance or the support level, 200-day moving average cracked yesterday, but now we're just kind of consolidating. So this is normal after you break a major technical level to consolidate, but you do want to be on alert for the potential of a false breakdown. So here's the S&P 500 over the last 3 months, and 200-day moving average was broken yesterday, and now it's in reverse. So we want to place, if we're a short-term trader, protective stop underneath these levels right here, 20-day moving average as well. That's what we're going to watch closely to see if that does indeed end up being a false breakdown and a reversal to the downside. Here's the sector ETFs for the day. Everything in the red. Tech is the worst off here. It's down about 1.5%. Real estate, utilities following on its heels. Here's what's happened over the last 5 days. Communication services and consumer discretionary. Those are the two best sectors. Mega caps really got some love early on in the week on that big bump up. But energy is the biggest loser to the downside, down 1%. And given the fact that we had a huge breakout this week, I want to show you some of our leaders over the last 5 days. The top leaders are KWEB, that's Chinese internet ETF, IPOs, meme stocks, cannabis, ARK, emerging markets. You get the idea. These are some kind of fringe groups here, and so not really a core group of stocks that you would think confirm the latest strength. So maybe jobs report, pouring a little bit of cold water on things today.
All right, we've been tracking some of that cold water this morning. Yahoo Finance's Jared Blickery. Thanks so much for breaking that down. I appreciate it. Our stat of the day today is focused less on pain at the pump. Gas prices fell to $3.45 a gallon. That is among the lowest levels since Russia's invasion of Ukraine in February, and a more than 30% drop from a record above $5 in June. Well, coming up, how rising interest rates could impact the restaurant sector. We're going to speak with an analyst from Bernstein next. The restaurant sector is grappling with rising interest rates, but our next guest says while the pace and the space should not face significant impacts, companies like restaurant brands and Domino's will be the most sensitive. Bernstein senior analyst Danilo Gargiulo joins us now. Danilo, great to have you here with us this morning. When you think about the space more broadly and how it can continue to weather some of the headwinds, what do you look for in a company that could perhaps outperform?
Good morning, and thank you for having me. Look, I feel the macro environment is particularly challenging for the average restaurant today. You know, you have commodities that have been elevated throughout 2022, expected to remain elevated in 2023, maybe with some kind of benefit toward kind of the middle of the year. Labor, has increased by about 10%, depending on the concept, and we are expecting labor to continue to be elevated, and therefore we are expecting companies that can maintain high margins to be relatively better positioned going forward. Essentially, companies that have kind of a resilient brand power and a resilient ability to maintain their margin power to be better positioned coming into 2023 because of the kind of challenging four-wall profitability across the stores in the United States and even internationally. So to me, like the biggest kind of tailwinds are going to be on companies that are able to maintain their growth profile in the long run as well, despite kind of the macro challenges that we are seeing today.
Danilo, you wrote a really interesting note recently looking at the effect of rising interest rates on restaurants. And this is, I have to be honest, restaurants and interest rates, I don't usually think of them as the first sector I would think of as being affected. But of course, if you're a franchisee and you want to open new restaurants, you're probably taking on debt, for example. So walk us through how the restaurant industry writ large is going to be impacted by these rising interest rates, how it has been impacted, and how much of a problem it is going to be for them.
Yeah, no, that's a great question. We had a ton of inbound from investors asking exactly how interest rates are impacting or are going to be impacting restaurants. It actually takes place in two forms. You mentioned the franchisees. Clearly, from a franchisee standpoint, it's about the unit growth. Having access to capital, having access to financing is fundamental to maintain their growth algorithm. This has, of course, also knock-on effect on the franchisors. So the likes of, the Domino's, the McDonald's of the world, who are relying on a unit growth algorithm for them to continue to expand the sales internationally, because of course, from an EPS standpoint, they're highly kind of dependent on the top line expanding. And so it has a dual effect on both the franchisees and franchisors. I would say on top of the unit growth, typically the kind of the average franchisor has also used kind of the low interest rate environment to fuel some of their EPS algorithm through share repurchases and dividends. And so we were trying to model out and trying to see over a long period of time, whether this impact of higher interest rates will actually influence the decisions of the companies, both from a kind of capital allocation priorities as well as their ability to continue to fuel the unit growth going forward. And frankly, I was very surprised with the results that we noticed in the data. I was expecting, just like many of the investors that were asking us this question, I was expecting some material impact on kind of the compounding growth of companies in higher interest rates. But in reality, the data doesn't tell us so. And so it kind of made us wonder why this dynamic was not playing out as per our expectations, and we think there is a couple of reasons behind the scenes. First of all, companies in the sector in the sector restaurant sector have long maturity of debt. Typically, about 90% of our coverage companies have debt that is maturing 3 years out. Or more, that was 80%, 90% of the debt is fixed, which means basically the kind of cash flow profile for these companies pretty much set for the foreseeable future. So they have a longer window of time to readjust their algorithm going forward.
That's really interesting. Danilo, within the food services landscape, food services and drinking place added 62,000 jobs during this most recent month, in the month of November. And when we think about the pace of hiring, as well as how all of these businesses are going to need to be able to keep margins and able to get through a challenging economic environment, what do you look towards for them to be able to maintain those margins while also still needing people, needing workers in order to make sure that they can service all of the customers that they are either bringing into in service or in-person eating capacity or delivering to in some cases?
Yeah. So if I can decompose your question into kind of expectations on labor and why kind of the added labor is essentially like a potential tailwind for restaurant, but at the same time, it may not be sufficient for restaurant. I want to say, look, right now the major response that restaurants have kind of adopted toward the tight labor market for restaurants has been essentially wage increases. Restaurants have been kind of the hardest hit sector in the United States during the pandemic, but it's also been the lowest sector to recover during the same time frame. It's also a sector that has seen the highest quit rate compared to any other sector, and so we are expecting that this is something that has some specific roots in the restaurant industry. It's not necessarily shared across the broader environment. In particular, what I mean by that is the pandemic has really taken a toll on the workers. The workers in the restaurant space have been pretty hard hit during the past 20 years by kind of low wages, working conditions that were poor, lack of flexibility. All these dynamics were actually being reflected upon by the workers during the pandemic. And so the quit rate has been particularly elevated for restaurants. The immediate reaction from a restaurant standpoint has been increasing the wages, because clearly this is the easiest way for any company to attract talent. But we don't think that this is going to be sufficient. In particular, since the restaurant space has the highest proportion of millennial and Gen Z being part of their workforce, and because we know that this generation is much more value-oriented compared to any other generations, we are expecting additional investments that restaurants will be taking in the form of higher benefits, in the form of better security in kind of better security and safety in restaurants, as well as additional investments when it comes to career pathing inside the restaurant chains. And so clear examples of how this is reshaping as we speak. Starbucks has launched a transformation which is also focused on kind of reigniting the labor workforce through more flexibility of schedules, as well as a better career pathing inside Starbucks. Chipotle has always prided itself for offering opportunities for essentially creating jobs for their own people, or essentially like a upward movement for their workers. Somebody working in a store could become a VP of a region, eventually could go into headquarters as well. We've seen the same dynamics with Darden. Yeah. Domino's shared that 95% of their franchisees are coming from the store itself. So There are many more venues outside of wages.
Danilo, we got to leave the conversation there today, but thank you so much for joining us and really breaking down the food sector segment. Bernstein Senior Analyst Danilo Gargiulo, appreciate it.
Thank you very much.
You got it. Coming up, we're going to speak with U.S. Labor Secretary Marty Walsh on the back of those November jobs numbers. That's next.
The United States created 263,000 jobs in the month of November. That's how many were added. Let's get more of a pulse on the jobs market with U.S. Labor Secretary Marty Walsh, who is joining us as he does every jobs day. Good to see you, Mr. Secretary. Thanks for being here with us. So we're looking at, yes, slowing jobs growth, but still the growth is happening. How are you thinking about it from inside the White House to sort of keep the momentum going, while at the same time, hopefully, also letting the Fed do its job in bringing inflation down?
Yeah, well, first on this report, as you said, it was a good, steady, strong job report. The unemployment rates in our country are near historic lows in all different categories. The black unemployment rate is 5.7%, which is still a bit too high. We have to bring that down. Latino is 3.9%. The Asian unemployment rate is 2.7%. So we have a little bit of work we have a lot of work, I should say, to do in the black unemployment. When I look at the report, when you dive into the report, there's a couple sectors that had really good gains this month that haven't over the last couple of months. And one is hospitality, leisure and hospitality. We added nearly 90,000 jobs in that sector. That sector has not fully recovered since pre-pandemic. We also saw in education a good, strong growth in private education in colleges, universities, of people going to work in those areas. And then when you look at the rest of the jobs report, when I think about that, it's really, and I think you hear about the noise about layoffs and hiring and job openings. It really is going to come down to now as we move forward, making sure that we're doing more precise job training, workforce development, apprenticeship moving forward, working with employers as we move forward here. I think it's really important. We're seeing wages go up. We're seeing some decreases in inflation. So we're starting to see a lot of the policies that are being put out there, both what the Fed's doing and what the president's doing, are taking positive steps in the right direction. So I just want to hope to continue a strong job market into 2023.
In the Fed's policy pathway, Marty, do you get concerned at the White House when you hear any of the Fed members talking about higher unemployment rates?
No, I mean, we don't really comment on Fed policy, and I know that that's pretty much been what I've been hearing for the last several months. But we have a lot of need in this country to get people to work, and there's a lot of job openings in this country. And what we want to do, I mean, after the last couple of years of the pandemic and people leaving industries and quitting their jobs and retiring and things like that, maybe coming back now, I think I'm going to stay focused in 2023 on creating opportunities and pathways into good-paying jobs. And I've spent a lot of time in the last several months and since I started this job, working with employers in this country, working with unions in this country, working with workers right groups in this country to really think about pathways into good middle-class jobs. And I think that we're going to continue that pathway because right now, I mean, it's working. I mean, you think about, we need to continue to bring those inflationary pressures down. But if we weren't talking about inflation, the economy everyone would view it as super strong. And unfortunately, the reality of the situation is we have more work to do to bring inflationary pressures down.
When you have those conversations with employers around the country, where are you hearing still the most acute need for workers right now?
Skilled workers. I mean, depending on the different industries that are out there, depending on the industry, whether it's healthcare sector, tech sector, cybersecurity sector, all those different sectors, they're looking for employees, and a lot of these companies were looking, several years ago for college graduates. A lot of them now are thinking that we can train people to get them in the front door to help us move forward and train them up ourselves. And we're doing a lot of this, particularly around apprenticeship. And we've spent, I think, $363 million last year, or this year, I should say, in apprenticeship and registered apprenticeship. And we're looking to expand registered apprenticeships. I mean, the apprenticeship program and the idea in the United States of America, we really think about it as construction. If you go to Europe, apprenticeship is in every industry. And a lot of companies now are starting to say, wait a second, I'd like to have an apprenticeship program here to really think about getting people in the front door and exposing people to my industry. And those are the conversations that I've been having a lot all over the country.
And that kind of dovetails into my next question with regard to where, going into 2023 and even 2024, where you've prioritized being able to have some of the barriers to legal immigration removed in order to attract some of that top talent, especially across science, technology, education, mathematics as well.
Yeah. Listen, I've been a strong proponent for a long time of immigration reform. When I was the mayor of Boston, I was a strong proponent of it. When I was a legislator in Massachusetts, I was a proponent of it. And now as Secretary of Labor, I really see on a nationwide level, obviously those are kind of micro to Boston and Massachusetts, but now on a nationwide level, when I talk to employers in this country, almost every single person, everyone I bring it up with, they all agree with immigration reform. And in some cases, people bring it up to me. We need a pathway for citizenship in the United States of America. We have to look at our immigration system. It's a threat to our economy. When people talk about inflation being the threat to our economy, I mean, obviously that's a major concern. I think the biggest threat to our economy right now is not having enough workers moving forward. And when immigration's talked about, particularly on Capitol Hill, they talk about it as regards to the border and the southern border. That's not immigration. We can create pathways for immigration in our country, and we have to take advantage of the folks that want to work in the United States of America to fill those jobs that we need to continue to grow our economy.
I just want to switch gears for a moment in our last couple of questions here and ask you about the railroad agreement that seems to have come forth and that the strike is going to be averted. Still doesn't include the sick leave measures for the workers, which is what they were really holding out for. Is there anything you can do outside of this legislation from your perspective, to help support those workers who do not have that paid sick leave?
Yeah, certainly there is. I just want to back up a minute here. This negotiation was at a standstill until the administration got involved. The president appointed a PEB, the Presidential Emergency Board. It came back with recommendations. I had further negotiations in my office with the unions and the companies. We were able to get some other benefits there, and we're able to get a contract that has 24% increase, wages, healthcare capped at 85-15, 85 out of the company, 50% out of pocket by the workers, additional language for work rules, and 3 unpaid days. I think moving forward, my opinion and my comment and my discussions with the company is going to be, you have to have real serious conversations with the unions to talk about what the future of your industry looks like in 2 ways. Number one is having a serious conversation about paid leave, paid sick leave for your workers, for your employees, and number 2, staffing up. Right now, the railroads in our country are severely understaffed, and these workers are overworked, and a lot of them were looking for additional days. Now, they were able to get 3 through negotiation in my office, but they're looking for more because of in large part because of understaffing. So I think it's important now as we take the next step, and I've told the companies the representatives of the companies this, I plan on meeting with the companies to talk about it. I plan on talking to the unions and keeping these conversations moving forward. Certainly there's a lot of interest in helping these workers and making sure that there's sick leave provided, paid sick leave provided for them. But this wasn't the only thing in the negotiation that the unions didn't get. There was other things that they asked for in negotiation, but through the negotiation process, they weren't able to secure it. But this is a strong contract, minus the sick time, the paid sick leave, and that's what the workers will think, but it's a strong contract.
Marty, just while we have you here as well, we've continued to focus in on the labor force participation rate, and particularly where people are not reentering into the workforce. What do you believe from the White House perspective that is going to need to be enacted for people who are on the sidelines, who want to get back into roles, or perhaps those who don't want to get back into roles, to be part of that labor force participation?
Well, we had that conversation this morning when I was going over the numbers here, and the one number that kind of jumped out at me was the increase in hospitality and retail that in tourism that hasn't been there. We gained about, I think, almost 90,000 jobs this month, and I know it's only a 1 month indicator, it's only a 1 month number, but that's the sector that hasn't come back fully. There's still a lot of people that were pre-pandemic work in that sector that haven't come back to work. And when I saw that number today, I was starting to think, are people starting to get back into the sectors that they were in previously to the pandemic? I think that there has to be a multiple approach. I think, number one, we have to work very closely with businesses, and then we have to work with local governments on workforce development and job training, because a lot of people that might have left in industry during COVID don't want to go back into that same industry. But there's lots of opportunities for job openings in our country. There's lots of good jobs in our country that are available. And moving forward for the strength of our economy, we need to start helping people, skill them up to get them into better paying jobs. And some people aren't they're not in the labor force for a whole host of reasons, but I think there's some work we can do in the new year here to hopefully get that number higher.
It's always good to get some time with you on this Jobs Day. U.S. Labor Secretary Marty Walsh, thanks so much. Appreciate it.
Thank you.
Coming up, the labor market continues to take hits from layoffs, even as we see the overall numbers continue to rise. We will talk about the latest there next.
Welcome back to Yahoo Finance Live on this Friday, December 2nd, 2022. I'm Brad Smith here with Julie Hyman. Brian Sazi is out on assignment. It is Jobs Day in America, and their jobs report, it came in hot. The U.S. economy added 263,000 jobs in November, higher than the expectation of 200,000. Unemployment coming in at 3.7% here, and the market's not liking this news. We've seen declines across the major average. You've got the Dow Jones Industrial Average down by about 0.7%. This is a 3-month look. We'll take you to a 2-day view. How about that? Where we are down by about 1.125% over the past 2 days. And then just to give you a kind of 5-day view at what's taking place over the course of this week, you can see that move higher on some of the commentary from Fed Chair Jay Powell in a speech earlier this week with Brookings. But this move lower, this latest leg lower, that coming off of course, today's jobs report that did come out. We've also got the S&P 500. You're seeing that lower by about 1%. We'll round that off too. And then additionally, you're checking in on some of the sector movement that we're seeing on the day. Just briefly, we had all 11 S&P 500 sectors in negative territory here earlier on in the day. Some of the biggest declines, and we'll put that on an intraday view for you, were in technology and utilities as well as real estate. I'll toss things on over to you, Julie.
Ooh, that's a lot of red. All right, bonus cuts are expected to happen across Wall Street this year. Bloomberg's reporting that Goldman Sachs, JP Morgan, Bank of America, and Citigroup are weighing slashing end-of-year bonuses by as much as 30%. This is several companies across multiple sectors have announced layoffs. It's interesting to see this happen within the financial sector here. Investment banking revenue across the 5 biggest U.S. banks was down by 47% in the first 9 months, so not necessarily surprising. What's interesting about Goldman Sachs in particular, and there specifically, they're talking about the compensation pool being slashed by a low double-digit percentage, according to Bloomberg. What's interesting is that particular division within Goldman, the global markets division, is actually seeing outperformance. But because the firm overall is, having more of a slowing, they're talking about cutting. So it's an unusual time, I would say.
Yeah, it is unusual, and especially a different kind of tenor that we're hearing now from some of the largest banks who bonuses would typically be one of their major retention plays, especially for the top talent that they do have. And now it's more of a question of, for the talent hoarding that we had heard about some of them enacting and moving forward with, or at least holding on to a certain amount of headcount, just so that when they do go into next year and perhaps some of the deal pipelines finally start to open up or kind of return to turning on some of those spigots, if we do have that return or resurgence in demand, that they would have the necessary headcount. And this would be one of those major retention efforts. However, it's clear now that going into next year, there might still be a lot of lingering uncertainty about how, for each of these companies, where those deals will reemerge, and within the markets that they operate as well, where those returns will actually remain intact to make these bonuses viable or something that is not detrimental to their balance sheets going into that event.
Yeah, and of course, what this also reflects is the larger trend among corporate America, where once again, we're seeing the power maybe swing back a little bit towards the employers from the employees. That said, we just heard from Secretary Walsh that a lot of companies are still having problems finding skilled workers. Yeah. So, and there has also been some reporting that for the folks who are getting laid off from white-collar, highly skilled jobs, that they won't necessarily have trouble finding other jobs, because there are still companies that are hiring for that level of worker. So we'll see how the flow of workers kind of goes as we head into 2023, given all of the layoffs that we have seen.
Yeah, absolutely. David Solomon, in this most recent quarterly earnings, he had said against the backdrop of uncertainty and volatility in the markets, they continue to prudently manage their resources, remain focused on risk management as they serve their clients. And you've heard that in and positioned or packaged up in many different ways among some of those companies that we just showed the logos of on the screen as well.
Yes, we have. It's been a common refrain.
Yeah, indeed. Well, before we head to the break, let's check in on one trending ticker. Shares of DoorDash, ticker symbol DASH. It's moving lower by about 2%, following a downgrade to sector outperform by RBC Capital Markets due to increasing competition from Uber, as they are taking over significant share of key markets. The firm is also cutting its price target on the delivery service to $60 from $70, as RBC estimates deceleration in the coming year. There you're taking a look at the performance year to date. They're down a little over 60%. Coming up, SpaceX's latest FCC authorization. Julie is back with that, plus more headlines that you need to know. That's next.
Let's get down to business with some other headlines that we're watching right now. Florida is set to withdraw $2 billion of assets from asset manager BlackRock in the largest anti-ESG divestment by a state. The Sunshine State's chief financial officer wrote that BlackRock CEO Larry Fink is, he says, on a campaign to change the world, but using Florida's cash to fund the firm's social engineering project is not something the state signed up for. In response, BlackRock said it's surprised by the decision given the strong returns delivered to Florida taxpayers in recent years, noting that the action put politics over investor interests. Florida's state treasury will transfer all short and long investments to a new asset manager by early 2023. Elon Musk's SpaceX received a key authorization from the Federal Communications Commission on Thursday, giving the company approval to launch up to 7,500 of its next-generation Starlink internet satellites. The FCC did not grant a SpaceX full application for deployment of nearly 30,000 satellites. It's deferring the decision on the application to launch the full number to address concerns about orbital debris and safe space safety. To date, SpaceX has about 3,500 first-generation satellites in orbit and about 500,000 subscribers. And Maine lobster and caviar were just a couple of the dishes on the menu Thursday as President Biden rolled out the red carpet to host French President Emmanuel Macron and his wife at Biden's first state dinner. The leaders reiterated the resolve to hold Russia accountable for its widely documented atrocities and war crimes, as well as their commitment to each other as allies and friends ahead of negotiations over subsidies for U.S. products and other issues. This olive branch comes a year after the U.S. interrupted a multi-billion-dollar submarine deal for France. Also in attendance were celebrities, lawmakers, and industry titans, including CEOs of companies like Boeing, that is David Calhoun, and Walgreens' Rosalind Brewer, as well as Apple's Tim Cook. Brett?
All right, I'm sorry I couldn't make it. The outlook for tech is looking shaky for 2023 as the investors and the industry, they are lowering the bar for earnings, and companies continue to lay off workers amid broader economic headwinds. Here to discuss, we've got RBC Capital's Managing Director, Rishi Jaluria. Rishi, great to have you here with us today. First and foremost here, when you look across some of your coverage and the companies that have still yet to lower some of their earnings expectations, is the cloud in trouble broadly here as a trade?
Yeah, and thanks for having me. Look, I don't want to say the cloud is broadly weak as a trade. I think you hit on it though, right? What is really important is everyone wants to see numbers get lower, and the issue with a lot of these software subscription companies is the slowdown shows up on a lag, right? And so even if there's internally weak bookings numbers, it may not show up on the revenue line for 3-4 quarters, right? We've seen that happen time and time again. And there is still a lot of feeling of optimism at those companies that they're going to have a strong Q4, because Q4, which is going on right now for everyone, is kind of make or break for most companies. So it may take another, 1 or 2 quarters before we really start to kind of see numbers bottom out. And that's when I think the whole sector becomes a lot more ownable, is because that's when you start to get that upward revision to estimates again.
Hey, Richie, it's Julie here. I mean, as we look across the sector and across your coverage for that matter, a lot of the companies reported earnings after the close yesterday. There is some differentiation, at least in how the market is reacting to some of these. I mean, I look at the likes of a Smartsheet, which at least when we checked earlier was up on the day, and it seems to be perceived as doing better. Like, what is going to differentiate these companies in this challenging environment? How are some seemingly managing this better?
Yeah, I think Smartsheet and there's a couple others have kind of given a playbook for what you can do, right? Which is be really conservative in your assumptions, right? Don't just assume that macro stays the same, and definitely don't try to hide a slowdown. I think we've seen a number of companies say, oh, we're not seeing a macro slowdown, and then suddenly you actually see it happen, right? We've seen that happen with a number of names, most notably Smartsheet's competitor, Asana, which also reported last night as well. And Smartsheet has been upfront about some of the macro challenges they've been facing, and they're actually modeling in that macro gets worse, which is what we think is going to happen as well. So I think that's kind of the playbook that more and more companies need to follow, is adding in an extra layer of conservatism in numbers beyond what's already out there, and that helps give investors more confidence that numbers aren't going down, estimates aren't going down.
So this would typically be a time, especially on lower valuations, that we might see more deal making move forward, but it's also at a time where there's a very kind of cost-conscious restructuring that's taking place at many of these companies too. And so does that mean there's less of the acquire to grow strategy that will be enacted, or perhaps is there still some kicking the tires and deals to be done?
Oh, we definitely think there's a lot of deals to be done. The fact of the matter is we've gone through this era of SaaS sprawl for the past, decade, right? Where your average enterprise has more than 1,000 SaaS applications, and that's probably not the right way of doing things, right? I mean, platforms are what's going to win over time. And so we do expect that consolidation to happen, especially for more point solutions that should just be part of a larger suite of platforms. It hasn't happened yet. Most of the M&A we've seen has been in private equity land. But look, I wouldn't be surprised if we start to see the large platform vendors, especially once they have kind of confidence in the market, and then valuations kind of bottoming out, especially when private valuations also correct, because those haven't corrected yet. It's only been the public valuations that have. I think we could see a lot of the larger software vendors turn into acquirers and start to consolidate the market and consolidate budget.
Richie, finally, I got to ask you specifically about the largest company I believe that you cover, which is Salesforce. Is it a problem that Mark Benioff keeps chasing away his co-CEOs, and do you want to own the stock here?
Yeah, so that's the second largest company I cover. The largest one is actually Microsoft, which is one of the largest in the world. But yeah, no, when I think about Salesforce and the co-CEO structure, look, we've always kind of been believers that co-CEO is a really difficult thing to do, right? Unless it's a situation like Atlassian where the co-CEOs are co-founders, it's really tough, right? You need to have someone who's kind of the head making all the decisions. And so, we've seen twice now Salesforce try to do the co-CEO structure, first with Keith Block and now with Brett Taylor. And it just doesn't appear to have worked out long term. There's always the thought when these co-CEOs get announced that Mark is kind of going to work on his successor, and this is a step one in succession planning. But that just hasn't panned out, and so I wonder if the next move from here is does Mark Benioff try to find another co-CEO and try to groom another successor so he can focus more over time on philanthropy, which is probably his true passion, or does it mean that he might just kind of say, I'm going to go at this alone and I'm going to be in charge of this and not dabble in the co-CEO structure? In terms of the stock, I do think it is ownable here, right? I mean, we talk about what's going to happen in a downturn. Salesforce can definitely consolidate budget, right? I mean, they have so many different solutions across the sales and marketing and collaboration stack. And so they can get a lot more IT dollars over time, especially in a downturn where CIOs are looking to consolidate vendors and tighten belts. And it feels like Salesforce has a lot of room for margin expansion, a lot of room to improve their profitability. And it feels almost like a self-help story at this time. So I do think the stock is ownable, especially at, sub 20 times free cash flow.
All right. Rishi, really good to catch up with you. Thank you so much. Appreciate it. RBC Capital Markets Managing Director Rishi Jaluria helping us figure out how to navigate software stocks going into the new year. Thanks. Well, coming up, how the tightening labor market is affecting college enrollment. We'll speak with the president of the National Association of Independent Colleges and Universities next. The labor market shift is leading employers to adjust requirements for hiring, with job postings demanding a 4-year degree dropping to 41% in November, still down from pre-pandemic 2019 levels of 46%. That's according to data from the Burning Glass Institute. Joining us now to discuss the state of college enrollment, National Association of Independent Colleges and Universities President Barbara Mistick. Barbara, thank you so much for being here. So when we look at the requirements of employers, and we just talked about that statistic where we've seen it fall a little bit, what effect is all of this having on college enrollment? I mean, not just that, but obviously all of the pandemic sort of dynamics.
Yeah, you're absolutely right, Julie. You've got two different dynamics going on at the same time. So you've got a really low unemployment rate. You have employers that have lost employees during the pandemic period, and they're really looking to pull students who would normally come into college right into the workforce out of high school. So, that is having an impact. We see students in sending deposits in, signing up for college, and then not coming in the fall. And actually, they're not going to another institution. They're just not going into the higher ed system. So, this is going to have an impact long term because college is really, it's the ramp way to careers, not just to the first job.
It's also a ramp way to extreme amount of debt. So when you think about the number of people that are trying to figure out if this is a good return on investment, are there majors where you would say, yes, absolutely, great return on investment, this is going to pay off over time, land you a job and allow you upward career trajectory and momentum and advancement? And are there others where you would say, you know what, maybe a trade or maybe just getting some type of career exposure early on enough while you're in a college experience?
No, Brad, it's a great question. And actually, the data on bachelor's degree students, the average debt for a bachelor degree student is less than $30,000 a year. And that's actually gone down each year in the last 5 years. So if you look at this as an investment in your future, we know that students who go to college will make over $1 million additionally over their careers. And they're going to pay back in terms of their tax dollars as well. So any kind of federal programs, federal student aid programs that help students through college are actually it's a great investment for our nation because you're investing in the future. And then those students who complete school go on to earn greater amounts of money and pay taxes at those levels. So I think part of the difficulty is understanding that the big debt numbers that are out there are often for undergraduate degree combined with graduate degree. So I think if you take this one step at a time and look at it as a laddered approach, and also make sure you take advantage of whatever resources are out there. So at the federal level, there's Pell Grants for low-income students. At the state level, there are state grants. Private institutions give out over $43 billion a year in institutional aid. So I be a wise consumer, and I think you'll see that this is an opportunity for your career, not just for that first job.
At the same time, Barbara, I think student debt aside, people think higher education is too expensive, right? And it doesn't seem to be slowing down the rates of increase that we are seeing in tuition. Unless you can tell me differently, what do you think the trajectory is going to be? Do you see writ large the industry trying to keep a check on those costs?
Oh, the industry is working really hard on costs, and the best way to look at that is those College Board data, which shows that adjusted for inflation, the price of college is actually down. I know that.
Over what period of time?
That's over the last 20 years. So, what you're looking at today, the average tuition is about $32,000 a year today. So that's down considerably from, if you adjust for inflation, it would be up much higher. So, I think what's happening is there's this sense that it's unaffordable. And if you think it's unaffordable, then you're going to opt out immediately. And, I think what you have to do is really take a look. I think Brad made a great point. What kind of career are you looking at? If you want to be a data scientist, you can't just take one short-term job program and become a data scientist. You've got to, you've got to spend the time to learn the skills over time, know how to be a good problem solver, look at what you can do in terms of, not just, good communication skills, how to be an expert in your particular area, transferable skills, being committed to lifelong learning. These are the things that employers want. You're just talking today about the jobs numbers. Employers want those higher skills. The difficulty today is we've got this crunch happening with, low unemployment rates and, the desire to get people into the workplace right away.
Do you believe that there's a better way that we can design the education kind of structure within college just to make sure that people are not only getting the education that will go in tandem with the career that they want to do, but to have exposure to that career beyond just trying to apply for internships and being able to then perhaps land a job later on? Because there are a lot of college students that may be coming out next year and look at the environment and say, There are hiring freezes at the company I want to work with. There are layoffs that are already being rolled out. And there's clearly going to be some concern around cost structure for the headcount that companies that are some of the household names that they may actually decide to say, you know what? I need to go get a job as a barista before I can actually go work at the company that I want. Oh, yeah, and by the way, I'm saddled with debt.
Well, I think the best thing that you can do is to experiment with the career that you're interested in. So if you are really looking to be in a particular career, take any opportunity you can, both, internships you mentioned, externships, mentoring, looking at somebody that will let you shadow them in a career. If you've got family members or, use your extended network to take a look at a career and experience it ahead of time. Experience is a great teacher. I mean, I'd say be greedy about those experiences. Know your career, know what you're looking at before you step into the academic program.
All right, National Association of Independent Colleges and Universities President, thank you so much for joining us here today. We appreciate it. And it's Barbara Mistick. Have a great weekend. Thanks.
Thank you, Brad. Thank you, Julie.
You got it. Guys, stay tuned in this next hour for our What Just Happened special, where Akiko Fujita and Rochelle Akufo will do a deeper dive into those November jobs numbers here. But coming up, Tesla is hitting the accelerator on its semi-truck deliveries. We're going to share the details next. Ford is out with its latest sales numbers, reporting a fall in total U.S. sales in November. However, a rosier picture in sight for its electric vehicles. Here to break down all the details is Yahoo Finance's Pras Subramanian. Pras, what do we know?
So, we saw sales drop 7.8% in November. That's not too good. Probably due to some lingering part shortages, but EV sales were up over 100% in November. Ford says they now have an 8.6% market share in the EV market. Looking at some of their models here, the Ford F-150 Lightning EV, 2,000 sold in May. Now they're up to 13,200 for the year. The Mustang Mach-E up 14.5% in November. They've now said they crossed the 150,000 production mark for that car. So that's pretty big numbers for their first new overall EV. And the big dog, the F-Series pickup, they say it's poised to take the sales crown. They've sold around 580,000 of those trucks this year so far, but that's down 13% from a year ago. So they're doing well from the EV point of view, but overall, why still struggling with getting production? I don't think it's a demand issue. I think it's a supply production issue.
Right, they're still not able to do. Was it them with the heated seats? Somebody wasn't able to get the heated seats in.
You had to pay extra for the heated seats.
Yeah, I can't remember who it was. Yeah. I also want to ask you about the Tesla semi-truck, which, in true Tesla fashion was delayed. But finally, Tesla delivered it to Pepsi, yesterday or last night?
Yeah. So we saw the production version of this truck, the Tesla Semi. There's some questions there with the truck's kind of sort of specs, but they delivered it Frito-Lay and Pepsi are using it right now at their Modesto facility. Musk says that it'll have 500 miles of range on a full 82,000 pound freight sort of weight, max weight there. What we don't know is the load capacity of the truck. So how much does that truck weigh versus how much freight is it carrying? It's a big question we want to know. Also, price is something we want to know. But real quick, it's going to have a tri-motor setup like the Plaid powertrain, so it's pretty interesting stuff there. And also a new megawatt charging capable plug. It'll be able to take that. And the big news, the surprise they mentioned was that the Cybertruck will be able to take that megawatt plug. That'll give you 1,000 watts of power, which is huge numbers for charging. They say in the next year you'll start seeing superchargers get that plug.
The Cybertruck when it comes out, you mean?
Yeah.
When that exists?
Yeah.
When we can actually
supposedly next year.
drive it?
Supposedly next year.
We've heard that before. We'll see what happens. All right, thanks for us. Appreciate it. Turning out to the crypto space, which cannot seem to catch a break. According to a tweet earlier today by the CEO of Binance, the cryptocurrency exchange paused withdrawals of 2 tokens in particular that were potentially targeted by hackers. Here with all the latest, Yahoo Finance's David Hollerth. This kind of stuff does happen relatively regularly, David. I think it's just all of this is just getting a lot more scrutiny now.
Yeah, absolutely. And this morning, this is 2 smaller tokens that are not part of the top 100 cryptocurrencies were stolen and have since seen their value plummet. And that's been the Anchor protocol and the Helio protocol. And so what appears to have happened, according to Binance, at least in the initial analysis, is that an attacker stole about $500 million from the Anchor protocol, and that appears to be the result of getting access to a developer's passcode. Since then, there's also been about $15.5 million that has been either taken by hackers or opportunistically from arbitrage traders who've sort of seen a price difference since the initial tokens were stolen. So again, this is, for the year, a smaller hack, but obviously it's just, kind of the latest stolen theft we've seen. And to your point, Julie, we saw the first hearing in the U.S. regarding the FTX collapse yesterday, testifying before the Senate Ag Committee. Rostin Binham, the CFTC's chairman, had pointed out to the failures of FTX and essentially suggested how much reign he didn't have over FTX International. To his point, the one and he pointed this out. The one part of the FTX empire that the CFTC regulated was LedgerX, and LedgerX is the only or one of the few companies to be solvent as far as we can tell, and did not file bankruptcy. Binham also went on to emphasize the need for speed in crypto regulation, which is obviously an understatement at this point, as it's being measured. Progress in crypto regulation is being measured in years, as opposed to weeks or months now, as much as some people would, I guess, hope. But it does seem like there's a pretty clear consensus between the Senate and Binham just about the need to speed up. And then one more thing I'll point out is just it seems like the hottest thing going on in Q4 for crypto right now is distressed investing of crypto assets. And obviously that's because we've had a number of bankruptcies over the last couple of months. And just this morning, Galaxy Digital has announced that they have won the bid for Celsius's one piece of Celsius's assets, which is called GK8. It's sort of their custody solution. So we don't have the price for that acquisition, but it's said to be materially lower than what Celsius purchased the business for, which was $115 million.
All right, thanks so much, David. Appreciate it. Coming up, how the unemployment gap is impacting the labor market. We'll speak with the CEO of Goodwill next.
There's a lot of people that might have left the in industry during COVID don't want to go back into that same industry. But there's lots of opportunities for job openings in our country. There's lots of good jobs in our country that are available. And moving forward for the strength of our economy, we need to start helping people skill them up to get them into better paying jobs.
That was Labor Secretary Marty Walsh earlier on our show addressing the unemployment gap. A recent poll by the nonprofit Goodwill Industries International showed job seekers often lack the required skills and training even when the jobs are available. So let's talk about how to close the gap with Steve Preston, Goodwill Industries International CEO and president. And you know, it was interesting to hear Secretary Walsh address that head on. It's something he's talked about before, that there are these jobs, but you don't necessarily have the people with the skills necessary to fill them. And this, you know, we've been talking about this for a long time, it feels like, getting the people the skills. Where are we still seeing the sort of friction points or pain points in getting people the skills they need?
Yeah, well, it is an issue that has been growing for many years. And in fact, we saw research come out recently that looked at job descriptions from 5 years ago and compared them to today. And the same job, if you look at the job description, 37% of the requirements have changed. They've gone up. More requirement for digital skills, more requirement for different kind of engagement skills within an organization. And then if you look at broadly where the world is going, we're seeing more growth in healthcare. And right now, when you look at things like the infrastructure bill, which I know Secretary Walsh is very concerned about, we're looking at the need for trade skills. So the gap is in a few places. Number one is people really don't know how to find access to those opportunities, right? And what our poll did, you mentioned a poll we did earlier, what people told us in that poll is they saw jobs that they wanted, but they either didn't apply or couldn't get them because they didn't have the skills. And then we said, if you could get access to free skills training, would you do it? And 50% of them said yes. So it's helping people find out what's available. Once they get in, it's helping to support people through the process. Many of the people we serve, over 80% have a high school degree or less, have not been through extensive training programs, don't really understand how a particular kind of training will lead to a particular kind of job. And what we find overwhelmingly is that people succeed when they have a human being like a career navigator or a career coach that can walk with them through that journey and support them so that they are actually guided along the way, and in many cases, we'll help them get other supports with such as childcare or, healthcare or things like that may be obstacles in helping them get through the journey.
McKinsey had published a study talking about the great attrition, and specifically within retail, and that kind of leads me to think about which sectors would see the biggest churn rate in some of the headcount or the employment if we did have adequate upskilling, if we did have the necessary training in order to put people in positions that help them on the wage front outlast any impacts, or lasting impacts or stickiness of inflation, or where it could just create kind of a better life for themselves as well, or balance.
Yeah, I think that's a great question. Now, there is certainly sectors that have been kind of perennially depleted. Trades is one. Those are great opportunities for the people we serve because they, people get training that provides a long-term benefit. Often the trajectory is better for them. But what we find also is it's even those generalized skills that will open up doors for people. We serve hundreds of thousands of people each year in getting digital skills. And it's not just computer programming, right? These are gateway digital skills that allow people to apply for jobs that they wouldn't even be able to touch if they didn't have those foundations. So sometimes, they are things like trade skills or particular health care skills, but sometimes they are, and very often, they're these gateway skills that just open up doors that people wouldn't be able to open otherwise.
I'm really glad we're having this conversation, especially after we talked to the head of Association of Independent Colleges and Universities a few moments ago. But this is a good reminder that under 40%, it's just under 40% of the U.S. adult population that has a college degree.
Right.
Most people in the U.S. don't, and they need to have these kinds of skills. But I want to switch gears a little bit because it looks like we could be heading into a recession. What happens to funding for organizations like Goodwill at these periods of time, and how do you sort of buckle up and get ready for that?
Well, our funding comes from three sources. A very important source of our funding are the retail stores. If the retail stores are going well, the funding from the retail stores often funds local job centers or other kinds of human services that we provide. So if retail is growing for us, it provides us more funding there. We also get funding from various grant sources as well as philanthropy. So if any of those funding sources begin to diminish, it becomes a challenge, for service providers like us. We're unique in that we're a social enterprise. We're one of the largest social enterprises in the world. So that connection between the store and mission is helpful, but those other funding sources are very important. Smaller providers that do very good work in our community are heavily dependent upon philanthropy. And so if philanthropic sources begin to decline, which can happen in a recession, that becomes a big concern for them.
What kind of jump in partnerships have you seen in terms of the corporations that are working with Goodwill on the philanthropic side, but also on the job placement side and just upskilling people too?
Yeah, we have some terrific corporate partners, and it's both in the two things you mentioned, philanthropy and actually hiring people, but also in-kind support. So, Google is a wonderful partner of ours. They provide us with access to training and development for people with digital skills. Coursera is a great partner. They provide similar support. Indeed.com is a partner. They provide our participants access to their placement systems and provide enhanced support there. So what we have found, and in fact we launched an initiative over a year ago called Rising Together, which was an effort to bring in a number of corporations who cared about the same issues that we care about into this effort to change the face of opportunity for millions of Americans who don't have it. And many of them have provided philanthropic support. Many of them are hiring people, and very importantly, many of them are bringing sort of their organizational heft in ways that are unique to them. In our case, to help us move the ball forward for people.
Really appreciate the time here and the work that you and the team do, especially, and even more so than just the holiday season, but all year round as well. Goodwill Industries International CEO and President Steve Preston. Thanks so much, Steve.
Thank you so much.
Definitely. And everyone, coming up, we're going to do a recap of those November jobs numbers. We've got that on the other side.
the one number that kind of jumped out at me was the increase in hospitality and retail that in tourism that hasn't been there. We gained about, I think, 80, almost 90,000 jobs this month. And I know it's only 1 month indicator, it's only a 1 month number, but that's the sector that hasn't come back fully. There's still a lot of people that were pre-pandemic work in that sector that haven't come back to work. And when I saw that number today, I was starting to think, are people starting to realize, starting to get back into the sectors that they were in previously to the pandemic?
That was Labor Secretary here in the U.S., Marty Walsh, on the notable job growth in the leisure and hospitality industry as he weighs the idea of people previously employed in that sector before the pandemic that are returning to work. And it's noteworthy because this was the most impacted sector in leisure and hospitality. It saw the biggest declines here. And as it was pointed out within this report, leisure and hospitality has added an average of 82,000 jobs per month thus far this year. And that's less than half the average gain of 196,000 jobs per month in 2021. So that really shows you how far back this industry has had to climb as well.
Yeah, and it's still not back, by the way, because even with the gain of 88,000 jobs in November in leisure and hospitality, it has still not reached its pre-pandemic high of nearly 17 million workers within that industry. So it's still something to keep an eye on. As we leave you, let's take a final check on markets, shall we? Because we have been seeing downward pressure on the major averages as a result of what's going on in the with the jobs report. And we're going to keep talking about that. Coming up, stay tuned for our What Just Happened special, where Akiko Fujita and Rochelle Akufo will do a deeper dive into the November jobs report. You don't want to miss that.
This Friday, I'm Akiko Fujita along with Rochelle Akufo. Now, every Friday at 11 a.m. Eastern, we're going to be asking what just happened. It's our deep dive into the biggest story of the week and how it affects your investments in more ways than one. So we are kicking things off today with what we're watching. Well, some don't like it hot. The November jobs number comes in strong, but it isn't exactly what the Fed is looking for. Will the ongoing labor shortage keep people employed even in a slowdown? We're going to break that down for you. Changing times from FTX to Coinbase and Kraken. A crypto job was the hottest ticket in town, but the cuts are piling up. We're going to assess what happens to the best and brightest in this space. And school is out forever. It's a great time to check in with Chegg as college enrollment struggles to recover, and the IMF joins us to talk global youth unemployment. But first, as always, we are checking where the major indices are trading right now. 90 minutes into the trading day, all three major indices in the red, with the Nasdaq seeing the biggest losses so far on the day. A lot of this, as we said, is a response to that jobs report that we're going to be breaking down in just a bit. But let's do a quick check of the Treasury markets as well, because we have seen a pullback in those yields. And take a look at that right now. The 10-year yield at 3.6%, a 5-year yield at 3.78, and the 30-year yield at 3.65. It is now over to Jay Powell, though. The jobs report's blowing past expectations with an increase of 263,000. Average hourly earnings jumped and the unemployment rate holding steady. And you know what, Rochelle, all we have to do is really look at the markets to get a sense of how investors are actually breaking this down. The good news is things are still strong, but that's not necessarily good news for Jay Powell and company. When you think about where the Fed is trying to move, they haven't seen the kind of cool down they would like to see. And when you look at where average hourly wages are right now, jumping 0.6% for the month, wages up 5.1% year on year. That's not exactly where the Fed wants to be when they're still trying to tame inflation in a big way.
I mean, not at all. And we know that Powell just on Wednesday was saying that taming inflation, the biggest barrier to that is actually what they're seeing with the labor market, and because obviously it's fueling wage growth as well. And he said, to be clear, strong wage growth is a good thing, but for wage growth to be sustainable, it needs to be consistent with 2% inflation. And clearly we're far off that mark at the moment. And as you mentioned, this wages being up 5.1% year over year, well above that 4.6% expectation. And then you have to think, to have cumulatively have raised interest rates 375 basis points and still have jobs numbers coming in this hot. The Fed has its work cut out for them, and we're seeing the markets really digesting that at the moment, Akiko.
Yeah, there's a few numbers that kind of jumped out to me, Rochelle, when you kind of break it down by sectors. Retail and warehousing. I mean, this is kind of the area that we look to, especially with a lot of these retailers often hiring up going into the holiday season. We saw a pullback in those numbers in this latest report, which you could argue points to a sign of weak hiring for the holidays. Employment and retail trade declined by 30,000 in November. When you look at transportation and warehousing, we look to places like Amazon, of course, employers like that affected here. That number declined by 15,000 in November. When you look back to where it's been since July, we're talking about a decline of 38,000. So we always like to add the caveat when we're talking about the jobs number here that it is backwards looking. And of course, you know, the key is how much of the report we got today is really reflective of exactly where we are today. But when you think about sort of historically how the hiring jumps up, especially in retail this time of year, these numbers are certainly not pointing to a very strong number.
And I mean, we've been talking about this balance between really who has the power here between employers and employees. And it was interesting when you look at some of the upticks that we saw. The biggest jobs gains we saw, 88,000 positions added in leisure and hospitality, leading the job gains. Obviously, those were really at the brunt of the pandemic in terms of job losses. So to see those coming back, but obviously still a long way off from where we were pre-pandemic. And then you also have discouraged workers and those holding part-time positions for economic reasons. That also edged lower to 6.7%. So obviously a lot that the Fed has to digest here. Still more work ahead. It just depends on how aggressive the Fed is going to have to be based on this latest data, Akiko.
Yeah, and of course, when you think about, where the Fed is right now, we did get those comments from Jay Powell earlier this week that investors seem to be taking in stride, but it isn't just about one data set. Yes, the number today certainly coming in stronger, and we've seen investors reacting to that. Maybe good news isn't necessarily good news for the market, but when you look at, for example, weekly jobless claims, those numbers have ticked a little higher. So it's not necessarily that we're going continuing to see those job gains at the clip that we have seen maybe in the first half of the year. We're just not seeing the kind of cool down or the extent of a cool down that the Fed would like to see when you think about how tight the labor market is, how that's pushing up wages, how that's driving consumer spending. All of that adds to that inflation number that they just really want to try and get down.
Certainly a lot of nuance there. Well, we'll keep it going here. We have that strong headline number from November's jobs report, but how much does that figure actually matter? Well, we know the overall payrolls reports is a mix of two surveys conducted by the Bureau of Labor Statistics, the establishment survey of around 145,000 workers, and the household survey of approximately 60,000 people. But with these findings, as ever, the devil really is in the details. Well, lucky for us, we have Jared Blickery standing by to break it all down for us. Hey, Jared.
Hey there, that's right. We got two surveys, and each of them produces different numbers for us. So that headline payrolls number, that comes from the establishment survey. That surveys business leaders. That's where we get the 263,000 bump up that we saw in November. The unemployment figure that we get, the unemployment rate of 3.7%, that comes from a survey of households. But also in the household survey, they do try to calculate the number of payrolls gained, and that's actually a negative number, 138,000 to the downside. So there's a little bit of a difference there, but what is undeniable is those wage gains, which basically doubled estimates. And if you take a look at the price action here, and let's take a look at the Nasdaq, which is leading the way down today. Over the last 5 days, still up 1%. That's in large part because of this outsized performance that we had on Wednesday. Now, that was the key date when Jay Powell basically said 50 basis points in December. It'd take a lot to prove him otherwise, but the market took that and ran, now giving some of those gains back. So something very important to monitor going forward. Now, here are the S&P 500 sectors. You can see tech is a worst hit, followed by financials and utilities. And then if we take a look at our leaders here, Chinese stocks, those have been flying recently. That's in the forefront, but not much else in terms of risk appetite. And it looks like semiconductors taking the brunt of it to the downside, guys.
Okay, Jared. I guess, as we said, we're sort of looking ahead to that meeting with the Fed on December 12th and 13th to see, how they digest this, but certainly doesn't look great. At least investors are not necessarily liking the numbers that we got today. Thanks so much for that. Well, an ongoing developing story we are watching closely is, of course, the fallout from the collapse of FTX. The crypto exchange last month filing for bankruptcy after concerns were raised regarding Alameda Research's balance sheet. Founder Sam Bankman-Fried spoke earlier this week with the New York Times Dealbook, reflecting on the chaos. Take a listen.
I didn't ever try to commit fraud on anyone. I was excited about the prospects of FTX a month ago, and that's a massive failure of oversight of risk management and of diffusion of responsibility from myself running FTX.
And of course, Rochelle, as we continue to follow what exactly happened at FTX, so many of the questions surrounding this has been, what happens to the crypto sector moving forward?
And especially people who work there as well. And speaking of that, the wave of layoffs hitting the crypto sector really has gathered pace and derailed an industry that was going through something of a hiring boom. So where do we go from here? Well, joining us to discuss the job market within the space is Michaela Smith, Global Vice President of Talent at Chainalysis, a blockchain data platform. Good to have you on the show. So I want to first get your takeaways, because obviously we've seen a lot of tech layoffs, but what we've been seeing with some of these crypto exchanges is a different story. How is that affecting the movement that you're seeing from laid off crypto and exchange workers?
I mean, that's a great question. I can't really speak to other companies. Chainalysis has been growing quarter after quarter. We actually seen a 60% increase in applicants. And so our space is doing really strong despite what's happening in other companies in the crypto market right now.
Yeah, you may not be able to speak to other companies, but I do wonder what you think this means in terms of the growth that we have seen overall. Obviously, we've heard the layoffs from places like Kraken, bankruptcy filings from BlockFi, FTX. I mean, it's got to have some kind of ripple effect when you think about just how quickly things were staffing up pre all of this.
Yeah, it's really sad to see. I mean, layoffs affect everyone, both personally and professionally. And I think, you know, at the end of the day, Web3 and blockchain technology is the future of the financial systems of the world. So while I do believe for the short term, this has been a downturn for the crypto industry, I think there's really an opportunity here. Chainalysis' mission is to build trust and transparency in blockchain technology. And this moment in time, while in the short term is very painful, I think in the long term, this will help this technology be more safe and more transparent for users.
And so for people who are on the hunt for a job, what are some of the most in-demand roles in this space right now?
Well, it's funny. It really, you know, our employee base and the people we hire, we don't necessarily look for people who are in the crypto industry. The people we hire are a reflection of our customer base. So we hire people from public sector, from government, from media, from tech, all across the board. We're hiring in engineering and sales, marketing, even in my own function, talent.
Yeah, I mean, what does that ratio look like right now when you looked at job openings to applicants? I mean, how significant is the demand?
I think the demand is quite significant, especially when you look at the global markets. Crypto continues to be very globally focused, especially in emerging markets. And so you'll see a lot of hiring in the public sector space around regulation and compliance. And then again, this is new technology that's continuing to innovate. And so you'll continue to see investments in the R&D space.
And I just
Chainalysis Global VP of Talent, Michaela Smith, appreciate your time today. Thanks so much for joining us.
Thank you so much.
Well, coming up, the education situation. College enrollment in the U.S. has fallen for the third year in a row. So are we getting anywhere near pre-pandemic levels? We'll check in with Chegg after this break. With college enrollment down for the third straight year since the pandemic began, more and more people are looking at alternatives to higher education. So much so that even major companies like Google and IBM are reducing education requirements, instead focusing more on skills and experience. So what does this shift mean for our society and the economy? Let's bring in John Fillmore. He's president of Chegg Skills. John, this is an interesting storyline that your CEO, Dan Rosenzweig, actually flagged in the spring, saying that you were increasingly seeing more students forego college education for a job, a full-time job, largely because of inflation. To what extent have you seen that accelerate over the last few months?
You know, it does just continue, and you have the continued strength in the economy. And while we talk a lot about the headlines of layoffs more recently, the reality is there are still more technology job openings than there were pre-pandemic. And so there is a continued need to get people into the workforce. And the reality is there's also just a decrease in the ROI on the college education space. We've talked a lot, obviously, about the increase in tuition over the last few years. But the reality beyond that is only 60% of people who even start college graduate, and only about 50% of them end up fully employed after graduation. So really 2/3 of people who are going into college are not getting the outcome that they wanted, which tells you for a lot of people, if there's an easier, cheaper, faster way to get the skills necessary to participate in the labor force, they're going to go that route.
And are you seeing this more in some sectors than others? I know we talk about that in the tech space, but what about other sectors?
Yeah, you are definitely starting to see it more in places like healthcare. Certainly, if you're a nurse or if you're a doctor, there are degree requirements. But if you're thinking about things like pharmacy tech, if you're thinking things like certified medical assistant, you're getting a lot of places in that don't necessarily require a degree. And you are seeing more and more places that are struggling to fill those job openings say, wait, do we really need this degree inflation of saying the skills for this don't actually require for you to go to a 4-year college?
You mentioned the decrease on ROI of college education. I mean, what does that return on investment look like now? We've seen sort of the salary comparisons between high school education versus a college education. Has that divide been narrowed significantly because of the pandemic?
There are certainly opportunities for people, especially if you're in a sector like technology. We teach a lot of people in cybersecurity where the average job salary coming out for an entry-level job tends to be in the $70,000 to $90,000 range. So certainly in places like that, there are opportunities. And there's nothing wrong with a college degree. And obviously there are stats on the lifetime earnings of somebody who gets that 4-year degree. The problem is for so many people, they go into that situation, they end up with $10,000 to $30,000 worth of debt, and then they end up with no degree. And so you have this people with the overhang of debt plus no degree that essentially get no benefit versus being in high school. Now, what's changing in the world on this, and where you see incredible organizations like Opportunity at Work pushing on this, is to start this push, as you mentioned, to say, let's evaluate people on the skills. And so whatever their training is, whether you go to what we do with the Thinkful brand within Chegg Skills and you're learning cybersecurity, or whether you go to Southern New Hampshire University and you do 1 year or 3 years or 4 years, you're picking up skills. And if more employers, and as more employers start to evaluate you on that basis, you're going to see more and more people be able to participate in the economy that today are locked out.
And John, to that point about disparities, we know that sometimes when people sort of do a review of the jobs that they have, they realize that some of them don't actually require a bachelor's degree. But there is that consistency that some employees look for. They think there's a certain standard that comes with a bachelor's degree. What does it mean then if you have so many different organizations offering skills-based services and employers are trying to figure out who's the most qualified candidate based on just that?
Yeah, that's right. And it's also why you see companies like Vervo starting to jump out on the assessment space, because if you're going to move away from a degree, you need as an employer to be able to have some level of confidence that the person actually knows the skills. And so you're seeing incredible evolutions in the assessment space of being able to say, do you actually understand cybersecurity? Do you understand data analytics? Do you understand data science, which are some of the most popular jobs that we teach? I think you'll continue to see pushes on that assessment side as employers say, wait a minute, this certificate can show that you have the skills, but I do need to, for the old adage, trust but verify.
Indeed. Well, thank you for joining us with your insight. The president there of Chegg Skills, John Fillmore, thank you so much.
Thank you for having me.
All right, well, coming up, this is our youth. Some say Gen Z had the run of the workplace after the pandemic with more flexibility and a bigger voice. But has the pendulum swung away from this huge demographic? We'll find out next. Expanding our special jobs coverage globally now. Time now for our chart of the day. Now we're looking at data from the OECD about youth unemployment in its member countries. Spain, Greece, Costa Rica, Latvia and Italy seeing high numbers of unemployed youth as of this fall.
And something that has gotten a lot of attention this week, Rochelle, and we're going to keep the conversation focused on youth unemployment worldwide, from Asia to Europe and the Middle East. Those numbers have continued to tick higher, with Arab states seeing the fastest rise of unemployment in the youngest workforce. The lack of jobs have fueled mass protests, just like we saw in China this week. But our next guest says a poor job outlook doesn't always equal unrest. Joining us now to explain is Philip Barrett. He is IMF economist. Philip, good to talk to you today. Let's start by looking at these numbers. It's certainly noticeable when you look at a place like China, more than 20% unemployment among the youngest. As we mentioned, Arab countries even higher. What's led to that?
Good morning. It's a pleasure to speak to you. One of the things that we've seen in recent years is, as you mentioned, a pickup in youth unemployment. And part of that's been related to the pandemic and the scarring that we've seen from that. Obviously, the interruption of things like education and so forth during the pandemic have hit countries particularly hard where there is, say, less infrastructure for delivering that sort of education in alternate forms.
And we have seen them when it comes to economic slowdowns. It is younger people who tend to bear the brunt of it first and deepest as well. But I want to ask you, because you're saying that there's not a straightforward link between sort of economic and social conditions and the unrest.
That's quite right. So this is a question we've been studying at the International Monetary Fund for some years. And a story you often hear, for instance, around the Arab Spring in 2011, is that there is like a simple and direct link from outcomes like, say, youth unemployment or corruption or provision of public services through to social unrest. And one of the things we've been trying to do is to more systematically measure unrest and then try to explain it through different economic forces. And one of the somewhat surprising findings of that research is that those broad social and economic phenomena don't necessarily explain as much of the unrest as you would expect if it were true that those underlying economic forces were translating straight through to things like mass demonstrations, protests, and the like.
So what's actually fueling some of that unrest? If there is a consistent through line of high unemployment, but not every country that has that number is seeing the kind of unrest we're seeing in China, what has fueled that?
So I think it's important to have in mind perhaps a slightly deeper understanding of what drives unrest. And the way I've come to think about it through the research that we've done is to think about there as perhaps being broad sources of dissatisfaction or grievance in society, but that those don't necessarily always translate through to unrest. And those sources of unhappiness might persist for many years and may not translate to unrest, or they might be quite short-lived and they do translate to unrest. And so that then prompts the question, well, what causes that unrest and why is there this disconnect between these fundamental forces and the outcomes we see? And I think part of the answer there is in the nature of how unrest operates. If you go and protest on your own, it's at best an ineffective protest, and in some countries, potentially somewhat dangerous. And so as a result, that means that incentives for unrest for any one individual are larger when you think other people are also going to be out on the streets at the same time. And so that means that unrest can have this important sort of self-fulfilling or self-perpetuating component, that even if you're unhappy today about the basic economic circumstances of life, you might not go and protest unless you think everyone is going to go protest. But as soon as you think everyone is going to go protest, you might go and do that. And that's an inherent and difficult unpredictability that we think explains some of this departure of outcomes away from those fundamental drivers. And that's not to say that those fundamental drivers are not important, but the translation of those things into unrest is inherently unpredictable.
And Philip, I want to ask you about opportunities for young people, because the ILO says that they see opportunities for young workers in green, digital, and the care economies. But what is actually going to get them there in terms of the skills gap?
So I think what you're talking about there is a broad transition of economies towards those sectors that you're talking about there. And obviously, as you have more scope for opportunities in general, that's better for all workers entering the labor force. It's particularly important for young workers. But to return back to the question of unrest there, I think it's important to recognize that there's no magic bullet for either addressing the propagation of economic factors through to social unrest, be it youth unemployment or anything else. And I think we should also recognize that social unrest has important economic consequences that can happen.
They certainly do all feed into each other. A big thank you for joining us this morning. Philip Barrett there, IMF economist. Thank you for joining us. All right, well, let's continue our conversation with a focus on another aspect of youth unemployment. The youngest cohort in today's workforce, Gen Z, comes with a different set of expectations about work, from social responsibility to flexibility in work from home. But as the balance of power shifts back to employers, how will these trends square with the new economy? Well, joining us now, Yahoo Finance's Kelsey Barbiero. So what are we watching here? Because it seemed like the employees had all the power at one point.
Definitely seems like they did. I think that now people are a little bit worried about stability. I think that's going to be a big thing, like it would be for anybody. You know, we're a little bit scared about the economy. I think that people want to find themselves in a role that is going to make them feel, you know, like they might be there for at least a little while, given how things are. But I think outside of that, there are a lot of factors. I think that people really care a lot about a remote or a hybrid work environment. I think that especially there's a shift there where people at one point, I think, wanted to be fully remote. That was a big goal. And now we have all these recent grads who have never been into an office. And they're realizing just how important something like that is when they realize that, you know, they go to Slack their coworker and they don't know them, and it makes it really awkward and really uncomfortable. So I think that more people are looking for, you know, still that flexibility where they can go, you know, maybe work from London for a week, but they still want to be able to go into the office, feel like they're comfortable, they know their their employers, their coworkers. And that's another thing that I think people are really caring about right now is they want to know, you know, who they're working with. Are they going to be friendly with the people that are there? I think that people are trying to avoid a toxic work environment in any way possible. I see TikToks about it all the time, you know, the terrible boss or whatever. People want to make sure that they're going to be in a role that makes them feel fulfilled. And that's, you know, based on their coworkers, based on, you know, different perks and things like that. But I don't think people care as much about the Google type perks these days. I think people are more concerned about stability.
Yeah, Kelsey, you know, it feels like there's a bit of a reality check that's about to come with this particular generation, because as you point out, you know, a lot of these people just graduated straight into the pandemic in a remote environment. And what we're seeing increasingly is as the labor market, you know, sort of evolves here, and as companies struggle to get employees back into the office, they're increasingly saying, we're not going to do remote anymore. And we've seen data from places like LinkedIn point to that. What do you think that suggests in terms of the expectations for the youngest workforce when this is all they've known?
I mean, I think they're going to just have to figure it out. I think that that's what we've all had to do. I mean, I am 27 years old, so I have lived life in an office before the pandemic. I'm used to it. I know what it's like, but I get to be remote now, and that's wonderful. But I'm fully understanding that not every role is like that. And I think that a lot of people feel the same way. I think initially it might feel difficult for people to take a fully in-office position. But when they're faced with the reality of either not having a job or going in and, you know, making it happen, I think they'll make the right choice.
Okay, we'll be watching. Certainly employers hoping it's moving in that direction. Kelsey Barbario, thanks so much for that. Well, coming up, stay healthy. The United States breaks with many advanced economies on rules around sick leave for workers. And with no national standard, where is the solution? We'll discuss next.
As thousands search for employment or begin new jobs, they may be left wondering about their employer's rules surrounding paid sick leave, as well as maternity or paternity leave. Now, this, of course, includes the rail workers who continue to fight for paid sick leave. Yahoo Finance's Anjali Kamlani joins us now for more on how this is impacting the labor market.
That's right, Rochelle. We know that because of what happened with the rail workers, there's increased and renewed attention on paid sick leave. In fact, President Joe Biden just yesterday commenting on this as a result of the deal that was made. Take a listen.
I made it really clear I'm going to continue to fight for paid leave for not only rail workers, but for all American workers.
So as you can hear, he's going to renew this push, and we might start to see more discussion at the federal level. And this is because, of course, we've seen as a result of not just the rail workers, but also other low-income workers. Really, the lower end, or the lower quartile of the job market is where we've seen that gap in access to paid care. So if you take a look at the statistics, for example, the lowest quartile have 39% have access to paid sick leave. Part-time jobs are more impacted. 25% have sick leave versus 75% of full-time jobs. And we see that with states that have these laws, the Northeast and the West are really a majority of where they are located. A recent report from Health Affairs noted that, quote, the workers who are the most economically insecure are also those most likely to lack access to paid sick leave benefits. So what's been happening really for the last several months, and especially because of the pandemic and the attention on the need for time off, mental health as well, that conversation, there's been a lot of discussion about different types of leave and how companies can better cater to employees. There are discussions about things like unlimited paid time off, previously really just relegated to executives, and now a discussion among the general population. Caregiver leave, for example, AARP is tracking that. Some states have started to put that on the books. And of course, maternity, paternity, and family leave as well. That's really been increasing as a topic of conversation. And the U.S. lags other Western countries, especially Europe, in having those laws on the books nationwide. So it's really a topic of discussion that has been long overdue, something that we might see moving ahead because of what happened with the rail workers.
Yeah, Anjali, even before the rail workers, no question, just COVID itself brought the conversation about paid sick leave into focus. We're seeing a lot of cases of long COVID as the virus has these lingering effects on a lot of people. How is that affecting the workplace?
Right now, that's something that the Bureau of Labor Statistics is starting to track. As of last month, they added questions that included whether someone had to work from home, was using teleworking, and whether or not that was because of COVID or not. We've started to see that there have been questions really since the beginning of the year of whether or not COVID is impacting the labor force and who is showing up at work, how much time off is needed. And we're starting to see that increasingly, as we know with what happened, with the supply chain constraints, that the more workers that are taking time off because of a need to do so, either because of COVID or because of the other respiratory viruses, especially around this time of year. So it's going to be interesting to see how that data collection pans out and whether or not we start to more accurately track long COVID in particular and differentiate between just the time off needed for COVID as well as the lingering impact of COVID right now. We know it's been impacting the workforce, but the data is still really scant out there.
Yeah, and a lot of people are sure to take more sick leave as we continue to hear about these case counts going up going into the winter. Anjali Kamlani, as always, thanks so much for that. Well, as we continue on with our coverage of jobs data, ZipRecruiter is tracking the latest trends among various industries. For more, we welcome in ZipRecruiter Chief Economist Julia Pollack. Julia, I want to ask you first about the average hourly earnings, because that's sort of the number that really stood out to me when you look at the increase, 5.1% year on year, but we also saw upwards revisions for September as well as October. What does that tell you about just how much slack is still in the labor market right now?
So past reports that suggested that wage growth was cooling, it now does not seem to be the case. And there are reasons to believe that wage growth pressures will remain high for the foreseeable future. One, we still have a very tight labor market where people are leaving the labor force, not coming back. And despite huge gains in participation among younger workers, those are being more than offset by declines among working age people and older workers. Then we've also had, 20 months of very rapid wage growth, which have set expectations among job seekers. We just did a survey of people hired in the last 6 months, and 43% of them got double-digit wage increases. 27% of them got a signing bonus. Those are unprecedented numbers, and those are setting expectations among job seekers.
And it's interesting because on the one hand, you have this very strong jobs data, but then your data also shows that job seeker sentiment weakened in November. You would think that the employees would be in good shape, or prospective workers. Why are we seeing that difference?
Well, the tech layoffs are having an outsized effect on the sentiment of job seekers and their confidence for two reasons. One, they're hogging the headlines. But two, only 4% of job seekers are currently employed in tech, but 20% are looking for jobs in tech. The tech industry still is very much tied to our aspirations as Americans. This is the place to be if you want to get rich. It's the place where great innovations are taking place, where the consumer items that we most want to purchase are being designed and developed, Apple Watches and things like that. So this is still very much kind of the industry that dictates our moods.
So where are those who lost jobs in some of those companies we just showed? Where are they going? Is there enough openings still within the tech sector to support those who've lost jobs from these major tech firms?
That's what today's numbers up from the Bureau of Labor Statistics suggest. So in the techiest industries in the Bureau of Labor Statistics data, that's computer systems design and related services and software publishing, we saw a gain in computer systems design and only a very, very small loss, 1,400 job losses in software publishing. That's despite announcements of 20,000 layoffs in October and 40+ thousand layoffs in tech in November. And so those numbers are not showing up in the aggregate data, which suggests that those losses are being offset by gains elsewhere. There are still many, many tech companies that are doing very well, that are beating expectations on the street with each of their earnings reports, and that are hiring. And that the minute there's a big layoff announcement, are going and pulling that spreadsheet, listing all of the workers who've been laid off and having the recruiters reach out to them one by one.
The other sector that we saw see huge gains today, leisure and hospitality, adding 88,000 jobs in the month. This is, of course, a sector that was hardest hit at the height of COVID, leading to questions about whether, in fact, we'd get back to those levels. What does that number today tell you about how far along we are in that recovery in that sector?
So personal income has recently risen by a lot, not just because people are gaining jobs and labor market income, but also because of a boost from these inflation relief stimulus checks that many states are sending out. And that has fueled strong consumer spending on in-person services, where employment levels are still well below pre-pandemic strength and have a way to go to recover. That recovery is taking place because even as businesses say, hey, maybe we need to pull back hiring in case there's a downturn, they're not seeing that downturn. Customers are banging down the doors. We saw, everyone try to get Taylor Swift concert tickets, and that means that employers are saying, we can reduce hiring another day. For now, we need to make sure we have enough people manning those concession stands at that concert. We need to make sure we've got enough security guards. We need to make sure that we don't leave money on the table by canceling purchases and orders. So that's what's happening. People are hiring in huge numbers to meet the immediate business need that they're facing.
Certainly don't want any angry Taylor Swift fans. A big thank you to Julia Pollack there, ZipRecruiter's chief economist. Have a great weekend. All right, well, coming up, recession-proofing your career. Doctors, nurses, and teachers are all needed in a downturn. But have you ever thought about becoming a pro rat catcher? That job posting is up next. Checking on stocks that are currently off their session lows from the morning, which is of course unsurprising if you follow the good news is bad news mantra. Well, let's check in on the market action now with Yahoo Finance's Inez Ferrer. Inez, how's it looking?
Well, Rochelle, the Dow had been down about 400 points earlier. Now it's down only 30 points. So it's certainly coming off those lows, as you just mentioned. Some of that has to do, of course, with the U.S. dollar index, the dollar against a basket of currencies. It had been up after that hotter than expected jobs report, and it's coming down a bit. So that's giving support to equities. You are seeing, though, technology that is in the red, materials in the green. Over on the Nasdaq 100, I'm going to pull up a 5-day chart so you can see the gainers for the last 5 days. And Jared Blickery has put this leaders chart up. This is over the last 5 days. So you can see IPO, ARK, the meme stocks. These have been the leaders for the last 5 days, especially on Wednesday when we saw that big rally. So those speculative names really seeing gains. And then over the last 5 days as well, of course, the Chinese ADRs, not so much on what the Fed's doing, but on what's happening in China. BABA up 20%. JD.com also up 20% over the last week, guys.
Okay, Inez Ferrer with the latest market movers. Thanks so much for that. All right, we're going to do a hard pivot here to talk about rodents. New York City has a rat problem. We all know that. Anybody who's lived in the city, visited the city knows. That won't come as a surprise, but what you might not know is the solution could come with a big career opportunity. Yes, the city is now actively looking for a director of rodent mitigation or rat overlord to take care of the problem. The salary's in the neighborhood of $170,000 a year. If you've got experience, maybe you can get even more. Rochelle, anybody who has visited New York knows, but here, I want to put out this stat because I think this puts it in perspective. Rodents make up 25% of the human population in New York. We're talking 2 million rats. Is $170,000 salary enough to tackle all that? I mean, this is really going to test the labor market, I would argue. I mean, who wants to take that job?
I mean, the salary, yes, that's very nice, but look at what look at its face. Look at what you have to put up with. And where are you supposed to get rat catching experience from? Like, where did that come up in people's lives that you have rat catching experience that you'd qualify for this job? It's horrifying, but look, times are tough. If you could do with 170,000 and you're willing to, risk life and limb to get bitten by rats, more power to you.
You know what we need to show? If anybody's ever seen the pizza rat, I mean, that to me just shows, exemplifies New York. When you see a rat carrying a pizza on the subway. By the way, this New York Times story that kind of got a lot of us talking points out a really key issue here, which is it's not just about going after the rats. It's a trash problem, too. If you see trash day, everybody throws their trash out, the food out on the streets. That draws all the rats in. You've then got a breeding problem. So, I mean, I don't know. If you're willing to take the job for $170,000, more power to you. I would argue you might have a little more leverage in bringing that salary up higher, given the task you would have to take on.
And to your fair point there with the trash, that's because there is so much trash out there. This is why the rats are so healthy. That's why they can pull a slice of pizza up the stairs. Horrible, but hey, something for everybody. We'll have to leave it there and move along. But coming up, have we built back better? Well, President Biden had grand plans to create a fairer economy, expand the middle class, and compete with China. Is there any evidence, though, in the jobs numbers? We get into that next. The US added 263,000 jobs in the month of November, well above those expectations of 200,000. But what does that mean for the state of President Biden's economic plan? Yahoo Finance's Rick Newman now joins us to discuss this. So, Rick, too early for a victory lap at this point?
Not at all. Biden has been going around the country before the midterm elections and after the midterm elections saying, wow, the economy is just doing great on my watch. He hasn't really had anything to say so far today about the jobs report that was out this morning, but he will. And the White House is generally correct when they say there's been just a terrific pace of job growth under Biden. Now, that is not necessarily because of anything Biden has done. Obviously, he came into office just as we were getting into this accelerated snapback from the COVID shutdowns. But nonetheless, the numbers are great under Biden. And I track employment numbers and some other economic data under Biden and compare it with prior presidents. And if you go all the way back to Jimmy Carter in the 1970s, job growth under Biden is the strongest of any of those 8 presidents. So he does have something to brag about.
So how does he turn that into momentum, Rick? I mean, yes, we've got the midterms behind us, and it turns out, well, the economy wasn't as big of a hit to Democrats as we had anticipated. Inflation's still high, though, even if those jobs numbers are good. How do you make that a positive message?
Well, so Biden is going to keep doing what he's doing, going around and talking about job growth, the low unemployment rate. And Democrats may actually have a favorable window of opportunity here. So a lot of economists are saying they expect the economy to slow, and some are expecting a recession in 2023. Although if we're going to have a recession, I mean, it sure is not evident in today's job numbers. But let's say we do have a slowdown or a recession in 2023. It will probably be mild, and then we'll be into a recovery in 2024. And one would think that by 2024, inflation will be under control or close to it. So it's possible that by 2024, the next election year, Democrats are going to be able to say, look, we're back to a decent recovery and inflation is down. So I think that outlook is actually pretty good for Democrats and for President Biden.
Yeah, that's certainly the hope as the president sort of ponders over whether, in fact, he is going to run for re-election. Rick Newman, as always, thanks so much for breaking that all down for us. Let's do a final check of the markets before we let you go. As highlighted earlier, we are coming off of the session lows. We've got the Dow down 60, the S&P 500 down 17, the Nasdaq down 73. After we saw a significant decline on the back of what was a better than expected jobs number there. We are going to continue to track this, of course. All eyes now going from the jobs number over to the FOMC meeting mid-December. That is, of course, when Jay Powell will weigh in on the latest rate hike. Certainly expectation initially, Rochelle, appeared to be that given the numbers we got today, maybe that rate hike isn't necessarily slowing. But as we know, as Fed officials always remind us, it's not just about one data set. That does it for us on this Friday special. What just happened? Breaking down the jobs number for you. Remember we were talking about that rat earlier? Apparently we have video. Yes. There you go, the pizza rat. Horrible. $170,000 job out there for anybody who wants to take it to tackle this rat and many others, 2 million in the city. We'll stay on top of it to see if anybody snatches that job up. In the meantime, we're going to leave you with this image on this Friday. Thanks so much for joining Rochelle and I. Have a great weekend.